Hello, welcome to Sara Strat Sniper's Stratucation Course. We are going to talk about all things the strat. So, this is going to be lesson 1 on the strat basics. We are going to start with the 3 scenarios, learning what constitutes a candle as a 1, 2, or 3. And we're going to talk about Japanese candlesticks, which is what we use in the strat. We do not like line charts, and we do not like Heikin-Ashi candles because they give us lagging data. So, the first thing you need to understand about Japanese candlesticks is how they come to be, how they build. If you don't know what a candlestick is, we're going to cover it here. You have 4 components. You have the candles open, the candles low, the candles high, and the candles close. And these are important to note. So in any given time frame, this candle has traveled from all the way down here at the low to the high, and then candles have to open and close. So green candles open towards the bottom and close towards the top. And people tend to often confuse red candles and where they open and where they close. And it's very important that you understand that red candles are the opposite. So red candles open near the high and they close near the low. And depending on how some of these candles close, they can kind of give us clues, such as when a candle closes as a shooter or closes as a hammer. Okay, so here we have a bullish hammer and we have a bearish shooter. And what this candlestick tells you is that the price opened here, traveled all the way down here, and people started buying it up. So buyers rejected the downside, started buying up this candle, and it closed up here. So this is a bullish candlestick, and vice versa for the bearish shooter. So the shooter opened here, traveled all the way up to here in this candle's life, and then they started selling it off. So it closed down here. So knowing the course of this candlestick's life, this is a bearish candlestick, and we would expect continuation on the next candle. So if this candle closed bearish, you would expect bearish continuation. This candle closed bullish, you would expect bullish continuation. Okay, the 1, 2, 3s of the strat. There are only 3 actual candlestick types. You have an inside bar, which we refer to as a 1. You have a 2, which is a directional bar, which 2s can have 2 directions. You can have a 2 up or a 2 down. And then there are 3s, which are often referred to as engulfing candles. So we're going to talk about them. And I don't want people becoming dependent on strat indicators. I want you to see these things for yourself and be able to call them out on a chart when you see them. So a 1, like we said, a 1 is an inside bar. So this candle, for example, is a 1 because it's completely within the range of the previous candle. So this is what a 1 is. It's an inside bar. Consolidation. Couldn't take out the previous candle's high, couldn't take out the previous candle's low. And when we refer to candles, we are always talking about the candle type in relation to its preceding candle, so the candle before it. Okay? So a 2 is directional. So in the market, there is basically 2 clear directions. There's up and there's down. A 2 up breaks the previous candle's upside. That's how you know it's a 2 up. Okay, simple. A 2 down breaks the previous candle's downside, and downside only one side. Okay? Then you have 3s, which are outside bars. Outside bars, it's kind of hard to see on this chart, but took out this candle's high, and it also took out this candle's low. So what I would like for you to do for practice is determine 1s, 2s, and 3s on your charts. I should also mention that in deciphering if a candle is a 2 up, it doesn't matter what color it is when you are deciphering the direction of the candle. This is red, but it's still a 2 up. So here, this is a green 2 down because it broke the previous candle's low. Let's talk about time frame continuity. What is time frame continuity? Time frame continuity is determining what color your candlestick is and how many time frames you have that are the same color. Now, this is very important. What determines time frame continuity is the candle's current price versus where it opened. So, what I recommend people do when they're learning is to mark your candle open. So, on this candle, because we just learned the open of a red candle is towards the top. Now, when we're trading live candles, it's important to know where the candle opened because the time frame continuity or the color of this candle can change based on if we're trading below the open or if we're trading above the open. So if you're trading below the open, the candle's going to be painted red. If you're trading above the candle's open, the candle will be painted green. So this is how we determine time frame continuity. It has nothing to do in relation to its previous candle. Everything is based on the current candle when we're talking about time frame continuity. Let's do a green example. So green, because we learned that green candles open towards the bottom, the open is right here. So anytime this candle was above this line, the candle color was green. Anytime we were below it, it was red. So at some point, this candle opened here and traded lower, and it was red at one point, but then it went back above the open and turned green. So time frame continuity can change when you're trading on live candles. Let's go to, this is a live candle because we're in the middle of September right now as I'm recording this. So this candle opened here and it traveled up and it was green when this candle was up here. Then we got a smaller time frame change in direction. So this is the monthly chart, but like on the weekly, we got a change in direction, which brought the candle back down, trading below its open and turning this candle red. Let's go to a live candle and look. Bitcoin opened on the 5-minute chart, right where I drew that white line. Okay, see how the candle just flipped red? Because it's trading below its open. So this is how time frame continuity is determined on a candle by candle basis. This is how the color of the candle is determined. Hey, welcome back everybody. So in the last lesson, we talked about what determines a candle's color. So in this section, we're going to talk about what that means. And I kind of want you to think about it in the most rudimentary terms possible. And what I mean by that is looking at any given time frame and any given candlestick, looking at what color it is and noting who would be in control. Because that's what time frame continuity does for us. It shows us who is stronger, the bulls or the bears. And we don't necessarily care who is stronger. We just want to play on the stronger team, right? So looking at these monthly candlesticks of SPX, each candle is 1 month of time. So looking at these candles, it's very easy to see what group is in control. You have green, so the bulls are in control this month. Next month, same thing, green, bulls are in control. Following month, red, a red 2 up. So the bulls tried to gain control, but once they fell back below the open, the bears took over. And it's just noting who is stronger, who is winning, who's winning the tug of war. So think of the open kind of like a tug of war. Whichever side is stronger, that's what color the candle is going to be. Now, when we talk about who's in control, the other side of that is, are we in conflict? And what I mean by that is, in the most basic thought possible, when you think of a 2 up, so the direction is up, when you think up in the stock market, you think green, right? And when you think down in the stock market, you think red. So that's important to notice this difference, because what this is telling you in a very simplistic way is that the bulls tried to take the price up, but basically failed and were weak. And then the bears took back over. So this is what we call conflict. So when you have a 2 up that is red, that would be a 2 in conflict. If you have a green 2 down, that means you're in conflict. And what that means is the bears tried to take the price down, but the bulls said, oh no, and came and turned the candle back green. So even though this was a down candle, the bulls are winning because they painted the candle green. And these are going to be very important when we start to learn about actionable signals and reversals, because we want the conflicted 2s. Because that's basically, it's tipping, the market is tipping its hand to us and telling us, hey, psst, the bears tried, but they lost. So we kind of have like a little secret, and we know we want to be on the winning team. So when the next candle comes, we know we're probably going to want to play it long because the bulls are in control on this 2 down. So noting candle color is just what we call time frame continuity. What color is the candle? When you start hearing people talk about full time frame continuity, what that means is having multiple time frames in sequential order the same color or trading in the same direction. It does not mean every single time frame has to be the same color from the year all the way down to the 1 minute. That's not what we mean when we talk about full time frame continuity. We mean having 3 to 4 time frames going the same direction or having the same color. And the time frames that you will use will be dependent on what kind of trader you are. So if you're a swing trader, you're going to care more about the 3 to 4 higher time frames. So maybe you use the 3 month, the monthly, the weekly, the daily. So you want those 4 time frames to be the same color, and you want to be trading in the direction of that color. So if they're all green, you're going to want to be taking signals. We're going to learn about actionable signals soon. you're going to be wanting to take those actionable signals long because the direction is long, it's up, it's green. Now, if you are an intraday, just day trader type, you're gonna not care about the yearly, the monthly. You're gonna focus more, if you're an intraday trader, you're gonna focus on the daily, the hourly, the 30, the 15, something like that. So 4 smaller intraday time frames. Okay, so for example, let's say you are a swing trader and you know how to swing to the short side. You might look at the yearly and say, oh, the yearly's red, good. Then you'll go to the monthly. You'll say, oh, the monthly's red, good. The 2 week, if you want to use the 2 week chart, you can use any time frame that you want. It's red. Okay, so there's already 3 time frames in alignment with the same color, which means when you're looking for actionable signals, which again we're going to talk about next, you want to be playing to the short side. Week, red, good. So this is what we mean by having multiple time frames, the same color, to give you the most high probability trade, and trading with the trend and not trying to trade upstream and against the market current. Okay, that is a wrap for time frame continuity. And the one thing that I want you to hold on to for the next lesson is failed twos. And again, a failed 2 would be a red 2 up or a green 2 down. All right, I'll see you in the next one. Welcome to lesson 3 of Stratucation, where we are going to cover actionable signals, the strat setups, and what it means to be in force. So we already learned about the different candle types, 1, 2, and 3, and we learned about time frame continuity and what determines a candle's color. Everything you are going to do going forward hinges on these setups. It's a 2-pager, and we are not going to focus on color right now of the candles. We are only going to focus on what it means to be in force. Too many people get too hung up on candle color and say, can I take this reversal if this candle's this color? And we're not trading color, we're trading the directions. So what these setups show you is that there is only a certain amount of ways that price can reverse or continue. And it's the only way possible. And if it's going to continue, it's going to look like one of these. If it's going to reverse, it's going to look like one of these. Everything we are doing on a live candle. So when you see these setups, this last candle is always a live candle. One thing to note before we get too into this, the left side of the chart is the bullish setups, and the right side of the chart is the bearish setups. So, what is an actionable signal to begin with? An actionable signal is a break above, if you're bullish, a certain candle. So in this instance, the inside bar. So the inside bar and up is your actionable signal. And when we say actionable signal, we just mean something from the strat setup sheet, because everything on here is an actionable signal, which means you can take action. So this top setup, a 2, 1, 2, this is also known as an inside bar break strategy, and it's pretty straightforward. So what it means is when this candle opens, anytime it trades above the high of the 1, it's actionable. It's in force. Anytime you're above that level, your target is the high of the previous candle. Now, remember, this last candle is live. Okay, let's pretend it didn't make it all the way up here. Let's pretend it triggered and then fell back below the actionable signal entry line. That means it triggered, but it's not sustaining and it's no longer in force. So in force means trading above its actionable signal. Same thing for the downside. We're always trading the last candle on the sheet, and it's a live candle. Anytime we're below the previous candle's inside bar, it's actionable and in force. You're targeting this candle's low. And again, if it triggers and then retreats, it's no longer actionable. You want to know about that, which we will talk about that a little more in depth when we talk about outside bars. Okay, the next setup is a 3-1-2. It's played exactly the same way as a 2-1-2. You have a bar, an inside bar. You're still playing an inside bar break play. Same setup, same target. Previous candle's high. On the downside, same trigger. Trigger / actionable signals is the same thing. So same trigger, actionable, same target, previous candle's low. The next setup is a 2-2 reversal. And what this means is it is a reversal of direction. So there's only two possible 2-2 reversals. A 2 down and a 2 up, or a 2 up and a 2 down. The candles have to be going in different directions. So this is a down candle because it broke the previous candle's low. This is an up candle because it broke the previous candle's high. This, the last two charts, this is your reversal. 2 down, 2 up. Over here to the downside, a 2 up met with a reversal, a 2 down. Okay, and we're always targeting the previous candle's low, the previous candle to your trigger candle. So this is considered your trigger candle, and this is considered your entry candle. So the actionable signal here is a 2 up. When this candle opens, breaks the previous candle's low, that's actionable. That's where you're starting your 2 down, 2 up, 2 down. So we're always asking, what is the next 2? Because we want to play the next 2 if it's a reversal. Okay, if you look at the first 2 candles in this sequence, this is not actionable. This is not a 2-2 reversal. Why? Because it's up, up. This is what's called continuation. 2 up, 2 up, 2 up, 2 up, going into the highs. Okay, we don't want to play that. We want corrective activity. This is why this is basically you're buying a pullback. But oftentimes people just buy pullbacks at random points, and they tend to get in trouble if they would just wait and wait for the actionable signal. Because using very simple logic, if you're looking long, if you're looking for a long play, price cannot go long or go higher until we break a previous candle's high. So a simple way to think, price can't go higher till we go higher. So let the price and the chart tell you when that time is. Okay, a 3-2-2 reversal. It's played exactly the same way as a 2-2 reversal. Again, you have to have a down candle, and then you would need an up actionable signal candle. Same to the downside. You have a 2 up, you need the down. So your actionable signal would be when this candle opens, breaks below, right here, that's when you hit it short. Again, we're targeting the previous candle's low. Page 2, a 1-bar rev strat. This is my bread and butter, and you could make a living trading only this one strategy. So a 1-bar rev strat takes out the previous candle's low, fails, and comes and takes out the previous candle's high. Now, we don't really call these 3 ups, even though they close to the upside. This would just be considered more of a bullish 3. And then same thing goes over here. Took out this candle's high, failed, took out the low. Fun fact, outside bars most commonly happen after inside bars. And the reason for that is because inside bars are usually much smaller bars compared to 2s. A 1-bar rev strat, so a 3, can happen after any candle type. So it can happen after a 1, it can happen after a 2. You can have back-to-back 3s, which are one of my also favorite setups. A pivot machine gun. It is a reversal occurring after 5 or more consecutive lower highs or lower lows. So you see how each one of these candles is a lower high until one of these candles breaks that pattern and you get a reversal. This is a 2 down, 2 up reversal. And what happens is anybody who is short in here, they have to buy to cover, along with natural buyers playing this reversal. So you get a pretty explosive move in that direction. Now, you might not always take out all the pivots, and that's okay. We never know how far price is going to keep going, but you can take profit at each one of these and continue to walk your stops up. Okay? You can also have an inside bar reversal that sparks the pivot machine gun. And again, anybody who was long in all this has stops at these candles low, so they have to sell to close, along with natural short sellers stepping in and clearing all this out. Again, you hope you target all of them, but you never know, so you want to take profit at the targets and be walking your stop down. This is called a rev strat. Well, technically, this is a 2-bar rev strat, which always starts with a 1, a 2 down, and then a 2 up. This is played the same as a 2-2 reversal, but with 1 extra target. And the significance to this pattern is you had an inside bar break to the downside that didn't go anywhere, didn't get any traction. So this shows selling exhaustion, especially when met with a 2 up in the other direction. Same with the bearish rev strat. You had an inside bar break to the upside, which was pretty much not met with any force, and then the bears stepped in and took it the other direction. Now, one thing that I want to mention on rev strats is You notice how this 2, 1, 2 up actually hit its target? That's fine. You can play this to the upside and then back to the downside. So you don't have to have a failed 2 this candle. And a failure of this candle would mean that it could not take out the previous candle's high. So it was weak, couldn't take that out. So with a Rev Strat, you can have a successful 2, 1, 2 up and then the reversal, or it can be a non-successful 2, 1 slight 2 up, couldn't take out the target, then a reversal. Both ways are valid. So here, I'll give you an example of what I mean of a 2 that fails. Let's pretend this first candle was this big, and this 2 up couldn't take out the target. This is an okay Rev Strat to play. So the 2 up can take out the target or not, it doesn't matter. And you might think to yourself, well, isn't this just a 2, 1, 2 reversal like what's on the first page over here? And yes, it is. But what's going to determine whether you take the downside or wait for the reversal is longer time frame continuity. So let's just say these are daily candlesticks, but we have a green month and a green week. You probably don't want to play this to the downside if you have longer term continuity. So you might sit this candle out and then wait for the reversal back up if you have longer time frame continuity and longer time frame magnitude. Speaking of magnitude, what is magnitude? Magnitude refers to the distance from your actionable signal to your target. This area is considered magnitude. So from your trigger to your target. And you always want to exit at your target. I cannot stress enough the importance of exiting at your target. Let's look at a live daily chart of Bitcoin, and we are asking ourselves, what is the next 2 most likely to be? We are trading currently as an inside bar right now. That doesn't mean it's going to stay an inside bar, because we know if it breaks this candle's low, it's no longer going to be a 1. You can only call a candle a 1 after it's closed. Because why? Because 1s can become 2s if they take out the previous candle's low. So we know that the most likely next 2 is a 2 down. So this is a bearish Rev Strat. You have an inside bar, a 2 up, it hit its first magnitude. That's why you want to take profit at your targets. Couldn't hit its second magnitude. Came back below the actionable signal, which was a break above the 1, had a continuity change. It was green to red. So the bulls on their attempt failed. So what's the next 2? 1, 2 up. Is it 2 down actionable? It sure is. Two up, 2 down. You would short here, and your target would be here. It's this guy, the bearish rev strat. So you need to know your actionable signals. So study this sheet. The actionable signals are the gray lines on these charts. So here, here, halfway. So study this chart. Like I said, actionable signal, when this candle breaks above that candle's high, target. That's all I want you to focus on right now. And go and find a chart. Go look at a chart. Go practice 2-1-2 ups. Go look for them. See if you can find them. See if they worked or failed. And that's what I recommend you do for practice. Just go on your chart, look for 2-1-2 ups, then look for 2-1-2 downs, then move on to the next combo. Go look for 3-1-2s, mark them on your chart, mark your entry, mark your target. This is going to help your brain develop muscle memory. Just continue down the list. Look for look for 2 down, 2 up reversals, then look for 2 up, 2 downs. Mark your entry, mark your target. One thing that I do want to say, because people always ask, what's the best strat setup? And there is no best, but one setup that I do feel like is safer and which one is less safe, anything that had a pullback is safer. So see how we have a slight pullback here and then resumption up? That's typically safer than an inside bar break, because this inside bar, like we talked about in the first video, it's consolidation. It's just sideways. So pretty much this would have stopped nobody out because no lows were taken out. So this is more of a continuation that you might find in a really strong ticker or intraday price action. Because remember, things are not going to go up forever, and pullbacks happen. So we want to wait for the pullbacks to happen so we don't get stopped out, and then we want to participate. But again, take this sheet, print it out, hang it at your trading station, and then go look for these things on your charts. It is what is going to help you learn and understand these faster. While you're learning, I don't really want you using strat indicators. I want you to see the candles with your very own eyes, determine if it's a 1, a 2 up, a 2 down, or a 3. And you already know the rules, so do your own, be your own indicator. Do not rely on indicators. I can tell you right now, this is a 1. It's inside this candle. This is a 2 up. This is also a 2 up. This is a 1. 2 down, 2 down, 2 down, 3. This is how I practiced and got good quickly at identifying what candles are what. Okay, to recap this lesson, we covered actionable signals on all of the setups. The gray line is the actionable signal, and we covered the target, the green line of all these setups. And we talked about what it means to be in force. Okay. See you guys next time. Hey everybody, welcome back to lesson 4 of the Stratucation course. This lesson is going to be on stop losses. So with the strat and with our actionable signals and full time frame continuity, the goal of our entries is to put us in winning positions, we want to know when the trade is going for us or against us right away. So we tend to keep pretty tight stops. Also, another differentiating factor of stop losses in the strat versus stop losses in regular technical analysis is stop losses in the strat are not used as worst case scenario. They are used to protect profit and to get us out of positions right away that are not going in our favor. So, there are two different ways that you can place stops for the most part. And we're not getting into multiple time frame analysis just yet. We are just teaching everything on one time frame, being very simple and straightforward. So, what we have here is a chart of the E-mini futures, and I'm sometime back, but you can see that we have a nice daily uptrend right here. So what this means is that you have full time frame continuity on higher time frames if the daily is in a nice uptrend. So what we're going to focus on is this 2 down and then 2 up reversal. So if you look at your strat combo sheet, the entry is a break above the 2 down when this candle opens. The target is the previous candle's high. So we have our trigger, which is at 41.55. So knowing that we have this nice uptrend, you can use a trend-based stop, which is a looser stop than the one I'm going to talk about next. But if you expect this uptrend to stay intact and you want to give your trade more wiggle room, you would put a stop at the low of your trigger candle. So this is your trigger candle, this is your entry candle. So you would put a stop here. Now, if you go and get your risk reward tool from TradingView, you're going to notice that this is less than a 1-to-1 risk reward. It's 0.8 to 1. So risk reward wise, this is not great. So the other place that you can place your stops is the 50% rule about outside bars. And we know how outside bars form is one side of the candle gets taken out, it can't hold it, and then it retraces 50% of the previous candle, and then we're going to target the other side of the candle. So we can also use the 50% rule as a stop because we want this to trigger immediately and we want it to hit our target. We don't want it to trigger and then begin to fail. That's not what we want when we expect to get in winning positions immediately. We learned about the 50% rule in the last video, in the actionable signals video. So you get your fib tool, you have the 0, the 1, and the 0.5 marked. So we know that the 50% mark of this candle, the closed candle, because we're pretending this is a live candle, is 41.34. We will move our candle to slightly under what half of the 50% rule is. So now when we get our long tool, we now have better than 1-to-1 risk reward. We have like 1.6 to 1. Okay. And if we go and look at this on a smaller time frame, because you might say this could have triggered and then it could have come back in. So let's go look at it on a smaller time frame, like the hourly, and let's see if it came back in on us. Okay, so here's the hourly time frame. our trigger is right here. And the 50% stop was right here. And as you can see, in 1 hourly candle, we tripped our trigger and we hit our target. And this never came back in on us. So this is a really good example of a trade working and working right away in your favor. This is what you want to see. What you wouldn't have wanted to see was it trigger and then fall back in. Because if it had, that would be a failure of the trigger and you want to get out. You want to protect your money. Let's look at another one. Right here, we have a daily rev strat. So a 1, a 2 down, followed by a 2 up. Target 1 was right there. Target 2 is always to make, or your main target is always to make a new pivot high to shake out people who were short against this pivot high. Okay, so let's grab our stop. Okay, so we can see just based on this candle, it opened here and they bought it from the open. It was just buying from the open. Okay, so you could have also used a 50% stop. So under 39.39. Okay, and let's measure the risk reward on this trade. Okay, so almost 2 to 1. So this is a great risk reward using the 50% rule. Because again, we want to get in positions that we believe are going to go right away. And if they aren't, we do not want to be in them because we expect our trades to work right away. Okay, so coming more recent in time, we have a clear downtrend. So looking at a downside strat setup, we have a 2, 1, 2 down. We know what our trigger is, a break below the inside day. Target 1, target 2. There's a third target down here. That's kind of pushing it for a 1-day candlestick. So trigger here. All right, so let's see what the risk reward is. Let's say we would expect to hit this target because we know that this can move this much in a day. That's not a whole lot for the futures to move. So that is slightly less than 1 to 1. Let's get our fib tool. Let's get a 0.5 level. So anything above 37.85. I got right about that area. Let's get our short tool again. Let's move our stop down to there, our profit down to there. So this is almost a 2 to 1. So the moral of the story is you want it to go right away, period. And ideally, it's going to hit your targets. Now, once it starts going in your favor, that's when you want to move your stop to break even. Because once you've hit your first target, you can take partial profit there and then move your stop to break even. And there's no better feeling than being a trader in a risk-free position, and then hold on to it and see if it can take out your second target. And then if it can, I'd suggest you keep walking it down to lock in that profit if you left a runner. However, in the strat, it is pretty common practice to take full exits at your targets. And if it's going to keep on going, you can look for an actionable signal back in on a smaller time frame. But that is for a different lesson when we're going to talk about actionable signals and domino effect trades and using multiple time frames together to form the highest probability trade with the lowest risk. Now, if you're going to use a stop way up here, as opposed to the 50% rule, you're going to have to size smaller because you're risking more money. Okay, so I switched to SPY so we could do a little position size calculation. So let's say you have, these are just nice round numbers. Let's say you have a $50,000 account and you only want to risk $500, okay? So using the full stop, so the trend-based stop, if you will, you could buy 82 shares of SPY, okay? Let's say you're using a 50% stop, so anything under 375.70. Okay, so you could buy, or sorry, you could short 170 shares of SPY and only risk $500. So your position sizing based on which stop you're going to use will affect your position size. And this risk reward is much more favorable than the stop all the way up here. And then again, once it starts to move in your favor and it goes 212 down, stop goes to break even. We want to know we're right, and we want to know we're right away. And then we want to protect our money at all costs, because if we don't have any money and we aren't tight with our stops, then we can't play this beautiful game anymore. And again, why we use the 50% rule is because we know about outside bars. So if this candle opened, went 2 down, and then turned around, we're going to become an outside bar, and we're going to go take out this high. So why sustain or take on all this risk when you know that the likelihood of becoming an outside bar are very great once we pass this 50% line? It's not smart. There's no reason for it. So that's why on the 2022 Strat Combo Sheet, we have updated the stops to a 50% rule. Okay, I hope this has helped you understand where to put stops and the fact that we move them and we try to be in break-even positions as often and as soon as we possibly can. And when trading the strat, we expect our targets to get hit and not our stops. But in the event that we are wrong, or for some reason time frame continuity changes and the direction starts to change, we are out of there. We do not hold on to losers. All right, I will catch you guys in the next lesson. Hey everybody, welcome to Stratucation Lesson 5. In this lesson, we are going to cover targets and profit taking, what is magnitude, and exhaustion risk. So targets, why do we have them? Well, it's important in any trading plan that you have your entry, your stop, and a target. Targets are also typically where we're looking for pivot highs and pivot lows as our main targets when we get into the price action. And those levels are typically where smart money takes their profit and dumb money likes to get in. And most of the time when we hit these targets, that's when you'll see some sort of reaction from the price or some sort of hesitation in the speed in which it gets there. And a lot of times you will see reversals happen after important pivot targets have been taken out. So if you are in a long trade and a target is hit, you'll tend to see a reversal happen where price turns around and goes the other way. Or if you're short, once the downside target is hit, you'll sort of see some bounce or reaction up after the target's been hit, because that's where people are taking their profit. Before we get into real charts, I just want to quickly cover what is magnitude. And magnitude is pretty simple. It's just the distance from your entry to your target. So basically your profit potential. And this is going to come into play in the later lesson when we start to talk about how to calculate your risk reward. Okay, so in this example, I am using the SPX 2-hour chart. The time frame is not important. What's important on any time frame is knowing where the pivot highs are and the pivot lows are, because again, price wants to gravitate towards those to generate liquidity, and people like to call these stop hunts, but we know better. So in this example, we're first going to start with this price action right here. You have a shooter. So your actionable signal is a break below that shooter. And your target is going to be this pivot low. So smart money are short and they get out here at their target. Dumb money or retail traders are taught to short a break of support. And you can see how this works out for people who short at the lows. So this is where smart money and us are exiting our shorts. Once you have made a new low compared to a previous low, that is what we call exhaustion risk. You are now at downside exhaustion risk because you've made a new low. So anybody who was long in here and had their stop at this pivot low is now gone. They got stopped out. So once your targets are hit, that is when you will tend to see reversals in the other direction. So since price hit its target, it is exhausted. This is price exhaustion. So then what? You can look to take a reversal the other way only when you've exhausted to the downside. So you've taken out an important pivot target. Okay, so what's the next setup that this chart offers? This is an inside bar at exhaustion risk. So we know reversals happen at these levels. And again, the main strat targets are always pivot highs. So if this is the actionable signal entry, that's your target 1. That's your target 2. So let's look at this for a second. So when we get in from here, we know we're targeting this pivot high. And look what happened when price reached up into that. It barely tagged it, and then what did it do? It fell and reversed. So we want to be taking profit right at our levels. So again, retail traders are taught to go long on resistance breaks. So if anybody went long right here, they're immediately underwater. This is what we refer to as breakout trading, trying to go long against the previous pivot high. We don't do that. We want to be exiting here. Then when you get really good, like we did down here, you can play both ways. So you could have been short to here, from here to here, then you flip and go long from here to here. You're exiting here. There would have been a smaller time frame reversal in here that would have told you to go down. But again, we made a new high. Okay, so then what's the next setup? A 2 up followed by a 2 down. What are your targets? A new pivot low. So price made a new pivot low. So now you're exhausted again. Okay. Then what happened? Then you can flip and go long again. You have an inside bar again at the bottom of price exhaustion. Target 1, target 2, target 3. So anybody, again, smart money, we are getting out at the top. In fact, we took this exact trade. Okay, breakout buyers who see a triple top, 1, 2, 3, want to get in when that breaks. Okay, what do you think happened? Do you think price continued to go up and that worked in their favor? No. What did it do? This would have been hard to play because of the gap, but a red 2 up in conflict, what's it coming for? It's coming for this pivot low again. You had all these targets. So when we talk about exhaustion and taking profit at your targets, this is why. Once a pivot high is taken out, you want to be out of your longs. Once a new pivot low is taken out, you want to be out of your shorts. Even right here, you have a 2, 1, 2 down. What's your trigger? 36.28. What's your target? 36.19. If you didn't take profit where you were supposed to and you held on too long, you would have hopefully been stopped out break even because price hit your target. You should have been out. But if not, it went completely against you. And that's all we care to do. We want to be in. We want to be out. We want the highest number of successful trades in our favor. And then we do it all day, every day, over and over and over again. You don't have to get greedy. You don't have to continue to hold. You have the strat in your back pocket. You know where price should go. So let it go there and then take your money. You'll hear me talk a lot about the Missy Elliott, which is kind of a pun or joke based off of her song. I think it's called Work It. But the lyrics are something, something, flip it and reverse it. And that's what we want to do when our target gets hit. We want to take this profit and we could potentially look to play the other way if we get a strat set up. So we were short from here to here. Now we want to be long from here to here. And if you can play both ways, the market is your oyster. There is nothing that you can't do or trade. You could trade the same name over and over in both directions. Okay, so we just covered how exhaustion risk can happen by price when we hit our targets and we make new pivot lows or new pivot highs. There is another kind of exhaustion that I want to talk about, which is time exhaustion. So if I'm playing a 1 hour strat setup, I want it to trigger with the most time left in that hour, because I know that there's going to be a full hour potentially worth of selling. So I want to get in with the most amount of time left. So say this is a 1 hour chart and price triggers right here, but maybe there's only 10 minutes left in the hour. It's probably not a high probability setup, and you may just want to skip it because time matters. Another example, if you have a weekly setup and it triggers with only 1 day left in the week, you're most likely not going to hit your weekly target. You only have 1 day to hit your weekly target as opposed to 5 days. So use time in your favor. And I hope you see why when price hits your target, you want to get out, because it typically does not tend to just keep going down, right? It tends to reverse and go the other way. And we know that people have their stops who are long right here, so they just got taken out. We know people who are short from up here have their stops up here and they just got taken out. But that's not us. We're doing the opposite of that. We're shorting to here, longing to here, and then it's just beautiful. So we don't want to be the dumb money who says, the market makers are stopping me out. No, we know this is going to happen. That is the target, to hit this. That's it. We know this. Okay, here is a daily example. You had a 2 up followed by a 2 down. Your trigger is right here when this day breaks below the previous day's low. Target 1. Do we expect price to come and take out these pivot lows? Yes, we do. So let's see what happened. Okay, so if you were short from here and you knew your major target was these pivot lows, you would exit there when you make new pivot lows, and then look what happened this day. Price instantly shot straight back up. So once you're short from here to here, again, that's when you can look for reversals to go the other way, because we know that this is how price moves. Price comes and takes out pivots and likes to reverse. So the Missy Elliott, and again, this is going to become very important when we start to talk about broadening formations. So let's see if price comes and makes a new high, playing off this 2 down, 2 up reversal if we got one. Let's just mark our lines. And now this is a new pivot high. So we have a new pivot low, and that's a new pivot high. Boom. So again, here you could be at exhaustion to the upside. So then you can look for reversals back down. And you get one only here, because you still have 2 up, 2 up, 2 up, 2 up. Oh, what's this? This is an inside bar at a new high, so price could be reversing. We know what we would be targeting, a new pivot low potentially. But nope, it goes out of your favor. So it doesn't always reverse, but if it's going to, we know what it's going to look like. A 2-1-2 down, we want it to continue. It doesn't, you get a strat reversal against you, you would cut it right there. Get out. Because price is obviously not continuing down. So this would have been a small loss. So you would have entered short from 43. Well, actually, this day triggered and went all the way down here. You could have just kept your stop break even after hitting 2 targets. But if you hadn't, you would have cut it at 53, so a $10 move. And that's the thing about the strat. We know if it's going to continue, and we know what reversals look like. It's the best thing in the world. Okay. Think that's a wrap for the profit taking lesson, and I will see you guys in the next one. Welcome back to lesson 6. This lesson we are going to be covering the flip, simultaneous breaks, and why Turnaround Tuesday is a phenomenon. So, what is the flip? The flip is the beginning of any new candle. So this can be on any time frame. Depending on what kind of trader you are, is going to pique your interest on what candles are flipping. So for instance, a swing trader is going to care about the more higher time frame candle flips, such as the yearly, the quarterly, the monthly, and the weekly. And day traders typically care about the day and under. So the day, the 60, the 30, the 15. And why do we care about the flip? Well, as we learned in lesson 2, a new flip can bring new time frame continuity. And we want to be aware of those things. So here we have an hourly chart of the ES Mini, and you can clearly see by just looking at each of these candlesticks what they're doing on each hour. So if we just start here, this is a big red candle. So we can clearly see this is going to be an hour of potential selling. Again, another red candle. It was selling, okay? Then the candle closed here, flipped here, and it was green and buying all hour. And this is also important because trading programs or trading bots are also programmed to buy and sell based on certain hours. So we always want to be aware of the flip. So here you can see you go from buying, you get a candle flip, to selling, 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 buying, selling, buying. And you see, very clearly what direction the market is going for that period of time. So when that time runs out, which if you are part of our community, we have a hourly flip bot because we want to be aware and ready if the direction suddenly changes on us, and we want to know when that flip is coming. So we pay very close attention to it. Something else that we talk about in the strat is a simultaneous break. And all that means is a whole bunch of stocks in the market are doing the same thing at the same time. So if that is occurring, that's the direction you want to be playing on because that's the direction the market is moving. Okay, here I have the S&P futures, the NASDAQ futures, and the Russell futures here. I have the 1 hour chart up. And if you look at the inside bar at 10 o'clock my time, you'll see all 3 of the futures, 10 o'clock, all 3 of the futures were doing the exact same thing at the exact time. So they all had an inside bar at the same time. So what is a simultaneous break? It's when all of the futures break to the downside at the same time. This is what we also refer to as market correlation. And if you're trading a stock, but the whole market is going to the downside, your stock is likely going to go to the downside. So simultaneous breaks are just that, when the whole market is simultaneously doing the exact same thing. Something that you'll hear Rob and other stratters say is, we want to be trading in the direction of the most twos in the market. So this is the most twos in the market. 2 downs, 2 downs, 2 downs. So this was a great time today to be short the market. When your candle flips is really important. So the market opens at 9:30 Eastern time, which means we want our second hourly candle of the day to roll over at 10:30 a.m. Eastern. And the way to make that happen on TradingView is by turning extended hours trading off. We in the Strat do not use after hours trading. We don't care about the after hours price action. It is low liquidity, low volume. People can't play stops, and we like to play against people's stops. So you want to have extended hours turned off. If you don't know how to do that, you have to do it on an intraday time frame, so under the daily, so the 4 hour, 1 hour, something like that. And you're going to click down here, and you want to click regular trading hours, because let's look at our chart for just a second. Let's look at this strat setup here. We have a 3, 1, 2, okay? But if we turn extended hours trading off, it's going to look completely different. So watch what happens. You got a 2, 1, 2. And these candle flips occur at the top of the hour. So this candle flips at 10 instead of 10:30. We don't want that. So make sure you're set to regular trading hours. Okay, let's talk about turnaround Tuesday. Let's pretend this is Monday. Okay, Monday opens right here and trades up. So if you were to look at a weekly candle on a Monday, the weekly candle is going to look exactly like the Monday candle because there's only been 1 day of price action in that week. So on Monday, the weekly candle is just Monday. As the week continues on, we can get a time frame continuity change on a Tuesday. So let's say this is Monday's close. Let's say overnight, futures moved down. So SPY gaps down a little bit and goes 2 up, 2 down reversal. So knowing what we learned about time frame continuity and how candles are colored, we know that if we're above the open on the weekly candle, we're going to be a green candlestick. If we're below the weekly open, we're going to be a red candlestick. So not only is this a time frame continuity change on the daily, it also just changed the week from green to red. So if the weekly is red and the daily is red, that's where we want to be trading, in the direction of time frame continuity, never against it. So this is why turnaround Tuesday is often so important, because if you get a reversal of the daily time frame, it's going to change or can change the color of your weekly candle. So when the weekly candle did look like this on Monday, now the weekly candle looks like this on Tuesday, on the close of Tuesday, because a weekly candle has 2 days of price action in it now because it's Tuesday. So the candle will look like that. Okay, so in this lesson, we covered what the flip is. We covered what a simultaneous break is. We covered that your candles should flip at the bottom of the hour, meaning 9:30, 10:30, you should get a new candle, 11:30, a new candle, 12:30, a new candle, so on and so forth, and how to turn off extended hours data. So if you're a day trader, you'll hear us say sometimes that A new hour is like a new day to us, and that solely comes down to the flip and time frame continuity flips. This candle closed here, opened here, an hour of selling. The flip happens right here, straight selling. The flip, selling, the flip, selling, the flip, buying. So very important to be mindful of the flip. All right, I will see you guys in the next episode. Thanks for watching. Bye. Hello there. Welcome to lesson 7 of Stratucation, Broadening formations. These seem to be the biggest hindrance in people learning the strat for some reason, and I really hope to change that for you today. So firstly, what is a broadening formation? And there is only one defining characteristic of a broadening formation, and that is when price action makes higher highs and also lower lows. So something that we found that kind of resembled a broadening formation was Mr. Pac-Man. And Mr. Pac-Man is chewing up and spitting out breakout traders. And so I want you to imagine when you're trying to find broadening formations on your charts, the Pac-Man mouth. And all we're doing is identifying price action that has higher highs and lower lows. So something like this. So if you just kind of start here, this high is higher than this high is higher than this high, and so on. And then this low is lower than this low, and this low is lower than this low, and so on and so forth. So all we are doing when we are looking for these is identifying this characteristic, higher highs and lower lows. I find people start to confuse themselves when they start drawing trend lines on broadening formations. And if you're new to broadening formations, I want you to skip the trend line part. I don't want you to draw them. I simply want you to focus on the price action and if price is making higher highs and also making lower lows. So why do broadening formations happen? If you remember in lesson 5, we talked about targets and exhaustion risk, and that is why broadening formations happen. So if you remember this 2-hour chart from lesson 5 on targets and exhaustion risk, if you were long from this 2-1-2 reversal, you would be targeting this pivot high, okay? So the goal is to take out that pivot high. So once it does, it takes it out, but it won't just stop right there. It might go a little bit higher. So this is your slight higher high compared to this previous high. And then that puts you at exhaustion risk to the upside because you took out your target objective. Okay, and then same goes for the bottom. So if you were to short this 2 up, 2 down reversal, you're targeting this pivot low. And this pivot low got taken out on this candle, came down a little bit further, which is totally fine because price can do that. The goal is to just get down here. And we know that price can't reverse until it reverses. So now this low is a lower low compared to this low. So in a broadening formation, again, they happen because your target got taken out. So you're exhausted because there's no more price action immediately near you. So that's when you'll tend to see a strat reversal based on your strat combo sheet at exhaustion levels. Now playing broadening formations, they tend to be more counter trade and counter time frame continuity trades, but they are acceptable to take if you know that you're exhausted. Okay, so now instead of people drawing solid trend lines I want you guys to kind of adapt the finger doodle model. And I know it sounds silly, but it kills the question, is this a broadening formation? Because all we're doing is identifying that we have higher highs and lower lows. And what I mean by the finger doodle approach is just draw your price action. You have a new high, you have a new low, you have a new high, you have a new low. So once we hit our target, our long target, we know we're exhausted and we know that price can reverse here. So we want to be looking for reversals, AKA strat setups, to take us back down. And also, this is why getting out at your targets is so important, because once you hit them, price doesn't tend to continue. Now, let's also remember that nothing can last forever. So a broadening formation, while it's happening, it's fine and great, but eventually it's going to resolve to one side, because this is price discovery. So it's either going to, instead of reversing here and continuing up, broadening formations can also break down and out of the broadening formation. And this is called broadening formation expansion, when price has finally picked a true direction and quits killing the breakout traders. Or they can break up and out. But while the broadening formation is occurring, we're going to take advantage of that. And when the time comes that it breaks out of the broadening formation, we're going to know about it. And we're going to trade it in that direction. So even if we take a short up here, because pretend, let's say we have a 2 up, 2 down reversal, and we take it and we go short right here. The moment we get a 2 back up, we know that that is a reversal. So potentially we are about to break up and out. And if you entered on the 2 up, 2 down reversal, you would cut it when you got a bullish reversal against you. Because again, we do not want to hold on to trades that are not going in our favor. And we want to be agile and not married to a bias, and we will change directions if and when the chart tells us to. And just like all the strat combos, broadening formations can happen on any time frame, and you want to draw them relative to the time frames that you like to trade on. So if you're a day trader, you're gonna, like we talked about in the time frame continuity course, you're gonna want to focus on the day down. If you're a swing trader, you're gonna want to focus on the week up. So what I implore you to do is practice finding broadening formations using the finger doodle model. And you can do it on any time frame that you want. But all you're gonna do is look for higher highs and lower lows. And the more you practice this, the better you're going to get at it. So like right here, I can see a high, a low, a new high, a new low, a new high, a new low, new high, new low. And this is a beautiful broadening formation. And it's also an example of a broadening formation that resolved or expanded to the downside. Right? Because price can't do this forever. If it did, oh my gosh, how easy would trading be? Okay. And then I see another one. We have a low, a high, a new low, new high, new low, new high, new low. It tried to reverse, and then you got a 2-2 reversal against you right here. So you would cut it, because again, it can't always stay in this nice pretty pattern. But essentially, if you were to go to a higher time frame like the 4 hour, these candles would be a bit more smoothed out, and it kind of did continue. It just really expanded. So do you see? We have higher highs and we have lower lows. And again, this is where breakout traders get killed. Okay, let's pretend this is right where the chart is and this is where we are. Let's pretend somebody went short as soon as support broke. They're immediately underwater. Okay? Because there's nothing to target down here. All right? Let's do like this. That's our last pivot high. So anybody who went long right here on a break of this pivot high is immediately underwater. Okay? Here's our most recent pivot low. Anybody who shorted here on a break of support, air quote, support, is our target. That's our short target because we're already short from here on this 2 up, 2 down reversal because we hit what? Exhaustion. That's our short exit. So retail traders who are taught to short support breaks, how'd they do? It worked a little bit for them. Okay. That's our newest pivot high. Anybody who placed an order to go long above this high, immediately against them. Okay? But again, breakout traders are trying to enter long here. We're long from down here, and we exit when we hit our pivot high. So this is the beauty of targets, of knowing when you're at exhaustion, of knowing when and what a reversal looks like. And so that is how Broadening formations happen. They happen by targets getting hit and smart money exiting at those targets and not breakout trading. Now, there is some misinformation out there on Twitter that you have to draw broadening formations starting with threes or from threes, and that is incorrect. So you'll see a lot of people drawing their broadening formations like this. And the reason why is because a 3 is a broadening formation on a smaller time frame. So this helps you only on time frames less than where you're drawing from your 3. And you can see that we have higher highs and we have lower lows. So if we go down to a smaller time frame, this 3 on the 1 week, you're going to notice is a broadening formation on a smaller time frame. So let me show you that. Okay, so here is the daily chart of Tesla, and you can see you have a low, a high, a new low, and then a new high. And this is where people are confusing themselves drawing these trend lines, because people might think, oh, well, we made a new low and we broke below my trend line, so maybe price is expanding down. Well, no, because price can go as low as it wants below its previous low. But until you get an actionable reversal and price tells you it's going to reverse, it can go as low as it wants. But once it comes back into this range, that's what we care about. So let's remove these drawing tools, because again, all we're doing is identifying that we have lower lows and higher highs. So even though price broke below its previous low, that means for us, for stratters, we made a new low, so it's time to look for a reversal. because we're exhausted. We have no more targets down here to aim for. Okay? So here we go. We have a 2 down, we have a 1, we have a 2 down. But this is a conflicted 2 down. So right here, when price went 2 down, 2 up, that's your exhaustion reversal entry. And what are we aiming for? We're aiming for a new pivot high. So once that target has been achieved, that's when, again, we're at exhaustion and we can possibly take a reversal back down. Now, you'll notice what happened here. Tesla did in fact go 2 up and then 2 down, but it reversed. So it took out one target and then reversed. So Tesla is a good example of this price probably is not going to come back down and make a lower low, because if it was, this 2 up, 2 down would have finished as a weak red 2 down. So Tesla looks like it wants to go broadening formation expansion, so up and out. So let's say you took this exhaustion reversal, which is totally okay to do, and you hit target 1. Okay, you could take partial profits here, and then you could have had your stop at break even. But when price opened here, traveled all the way down here, and then came back up, you would get stopped out break even, because you just changed time frame continuity on the day, because we are trading above the open. So somebody asked me a question today: how do we know for sure if the reversal is real coming off of the bottom of exhaustion? And what I said to them was, well, we never know for sure, but we know that we're exhausted, and we know when to enter on a 2 down, 2 up reversal. So we take our shot. So instead of this candle being this candle, let's say it was a 2 down instead. Okay, we would have entered here, targeting up here, right? Because we target pivot highs. If we would have got this, you could have done one of 2 things. So if we enter from here and price goes all the way up here, stop break even. If you didn't have a break even stop, you would certainly have a stop on a 2 up, 2 down reversal. We're playing what we see happening in front of us, and we know that we're exhausted, so we're going to enter. And if it goes in our favor and hits our target, great, because that's what we want to happen. This is the ideal scenario, to go long from here because we're at exhaustion and to take out this pivot high, which it did do that. We can't possibly know for certain if this is the bottom of the broadening formation. We just know that we could potentially be at the bottom of a broadening formation. And that's why we always talk in potentials, because we don't know for sure. We're not saying this is a definite 2 down, 2 up reversal at the bottom of a broadening formation. We don't know that. So if you're at the bottom of a potential broadening formation, you're going to look for bullish reversals. If you're at the top of a broadening formation, you're going to look for bearish strat reversals. Make sense? You got a 2, 1, 2 up. So you're looking for bullish reversals. Right there. Price made a new high. So that's where you would look to exit because you're exhausted. Now, you made a new high, but did you ever get a reversal back down? after making that new high compared to this high? No, you got a 2-1-2 back up. So this gave you no reason to go short after making a new high because we did not get the bearish reversal, right? So this is why we say we are potentially at the top of a broadening formation because we've made new highs. But without a reversal, that doesn't mean anything to us. Yes, we know we could be exhausted, but we have to see that exhaustion reversal back down. Okay, you didn't get it till here, 2 up, 2 down, and then it went against you. If you had a 50% stop, you would have been stopped out. That's okay. Take your shot, see if it comes back down. Well, it did do it, but it did it the next day after a gap up, and then you got a 1-bar rev strat, which is on the combo sheet. It's an outside bar. We know how to play them. And we target new lows. And you got it. We like to play long, short, long, short. You can make a living trading one ticker, one time frame, and playing it both ways. Okay, I'm going to show you an example of a broadening formation expanding to the downside. Okay, so this is the monthly chart of Roku. Here is a pivot low because it's the only one around. It's the lowest low in its nearby candles, so this is considered a pivot low. Okay, so when this candle went 2, 1, 2 down, did the 2, 1, 2 do its job? Did it hit its target? So the short would have been from here to here. So you would have exited your short here. So it did its job. So now it's at potential exhaustion risk. So that's when I don't want you to become reliant on these lines. I just want you to understand that you made a new pivot low compared to a previous pivot low, okay? Here's your previous pivot high. So let's get a line up there. So this was your downside exhaustion reversal after making a new low. You got a bullish reversal at downside exhaustion, and we know we can take those because we know we hit our target to the downside. We're exhausted. Now we're looking to come and take out this pivot high. Did we do it? Yes, we did. We took out our target. So you're long from here to here. That's when you want to exit your longs because you know you're at all-time highs and you know you're at exhaustion risk. Okay? So when we're at the top of a potential broadening formation, what do? We look for bearish strat setups. Okay? What do we get? 2 up, 2 down. Is this actionable? You bet it is. Why? Because we're exhausted at the top. Okay? So, what's our new goal from here? To come and take out this pivot low. So we're short from here, targeting here. Do we do it? You bet. Okay? So now we're potentially exhausted because we just made a new low compared to this low. So we would look for what? Bullish strat setups back up, targeting yet again a new all-time high. Do we get it? Nope. 2 down. Nope. 2 down. Oh man. Nope. 2 down. 2 down. 2 down. 2 down. 2 down. 2 down. 1. 2 down. 2 down. Did you ever get an actionable signal to go long at exhaustion? No. So this is a beautiful example of broadening formation expansion. High, low, new high, new low, no reversal, no reason to ever get back into this long. What would have given us the reason? A 2 up. But did we get it? No. This chart should be in a strat book. This was your first actionable signal. It was to go short. Target here. Exit your short. You won. You did it. You shorted from here to here. You're exhausted now. Flip. New month. Inside. No actionable signal. 212 down. Did it hit its target? Yes, it did. You're incredible. You did it again. Are we exhausted? Yes, we are. 2 down, 2 up. Oh my gosh, you did it. You made a new all-time high. You're incredible. 2 down, short it, target here, exit, and then you had a whole bunch of 2 downs. We're going to start talking about multiple time frames soon, and that's going to give you a lot of clarity in, even though it's continuing 2 down, 2 down, 2 down, 2 down, 2 down, there's no actionable signal to get in because this is continuation. Well, when we go to smaller time frames, we get plenty of actionable signals. Those of you who have been around long enough for the COVID dump, we know why it hit where it hit, and we know when it reversed and why it reversed where it reversed. Again, practice your finger doodles. High, low, new high, new low, new high, new low, mega new high. And I'd like for you to go through this chart and find all the downside exhaustion reversals, and then find the upside exhaustion reversals, and then the downside, and so on and so forth. Because if you do, I promise you will see exactly where to enter and where to exit and where we're going. When the COVID news happened and we started dumping, and we know that this is the last pivot low anywhere around, we knew we were coming to take this out. Hands down. And what does smart money do here? The whole market's panicking. Just blood in the streets everywhere. Smart money is loading under this low. And they sure did. Did you get a bullish downside exhaustion reversal after making a new low? Heck yeah, right there. 2, 1, 2 up after making new lows and becoming exhausted to the downside. And then, well, you saw how the rest of 2020 and 2021 went. Straight up. So as a stratter, it's your job to be thinking, hey, we just made a lower low. We just made a new low. I need to be thinking that a reversal is likely to occur. And if I was short through here, I need to be exiting here. And now I need to be looking for a bullish reversal. So that's all I want you to care about. Knowing when you're at exhaustion and then looking for a reversal. All right, so a few things to recap. Broadening formations have both higher highs and lower lows. A broadening formation has a top upward slope and a bottom downward slope, not this. Broadening formations don't need to be drawn off of threes. Threes are broadening formations on a smaller time frame and help you on the smaller time frame. Broadening formations can't stay broadening formations forever. They will resolve or expand either up and out or down and out. But while they continue, we're going to take advantage of them and we're going to play them only if and when we get a reversal. Okay, I think that's everything I wanted to cover. I will see you guys in the next lesson. Welcome to lesson 8 of the Stratucation course. Since we just covered broadening formations, we are going to cover tightening ranges, which is the opposite of a broadening formation. So when we talked about broadening formations, we discovered that they have higher highs and lower lows, and price is expanding. And when you're learning price action, it's important to recognize what kind of price action you're trading, because the market is usually going through price discovery and a series of broadening formations, or it's consolidating, or it's trending. When we were talking about broadening formations, we know that they look like this. Price is expanding and getting bigger. Well, when you have a tightening range, price is doing the opposite and it's getting smaller. So a good way to identify a tightening range or consolidation is you have lower highs and higher lows. Okay, this is what we call the no-no zone, which means you don't want to trade when price is within this pattern. And a little fun fact on tightening ranges is on a higher time frame, they are an inside bar. So if you go to, let's say, a 2-hour chart, so you had double inside 2-hour candles. So looking at this, you have your low and you have your high, and price has been stuck in this range the entire day. So what do you do? How do you play it? Well, you want to mark out your higher lows and your lower highs. So that was your previous high. This is your next lower high. This was your previous low. Here's the next low. And then you have this low as well. So you have this tightening range, right? Low, high, higher low, lower high, higher low, lower high. So you only want to trade this when this pattern breaks. So you would have to break a low in order to trade it, or you would have to break a high in order to trade it. Okay, so again, you will get chopped up in here. Things don't hit target. So this 2 down, 2 up reversal couldn't hit its target because you're stuck in here. All right, let's see what happens. So this is what happened at the end of the day. We finally broke the pattern of a higher low, and then that's when we got the flush. So again, you can go to a higher time frame if you want to play this, and you would wait for the strat setup, which is an inside bar and down. And it couldn't even take out its real magnitude of a new day low. But this is how you play it. You don't want to play it while it's in here. And this is consolidation. It is an equilibrium. It is market indecision. The market doesn't know what it wants to do. This is the only pattern you'll ever see me draw, which is a symmetrical triangle. In technical analysis, it's a symmetrical triangle. And the reason that I like it and I use it and I play it is because it's not biased. Because we know on a higher time frame it's an inside bar, and we know still what our actionable signal is. And if you remember from lesson 1, when we talked about what is a 1, what is a 2, what is a 3, a 1 is described as consolidation. So this is how you want to handle these. You don't want to trade in the no-no zone. You want to wait for the break. So if you identify a chart with lower highs and higher lows, go up a time frame or two till you can find the inside bar, because I guarantee you it's there. You just have to find it, and then you can mark your level. So for instance, we knew on the 2-hour chart that was our level to go short. So if we go to, say, a 15-minute time frame, you're going to see there's the break. That is the 2-hour inside and down break. In the strat, you will hear people talk about mother bar problems. And all that means is you have a big first candle. So this would be considered a mother bar. And all it means that price is stuck inside this big candle. So this is what we call mother bar problems. So you want to be aware of that and that you're trading basically a giant inside bar. But when the setup comes, you can take it, and the goal is to take out the low of the mother bar, because otherwise you run the risk of mother bar problems and staying inside all day. And another example of why we don't trade inside days, because that's the no-no zone. So if you look at this chart, you're going to clearly see you have a high to a lower high, you have a low to a higher low. So it's important to train your eyes to see these things so you know when to trade it or not to trade it. So this is what you would consider to be a symmetrical triangle. And over time, as you practice trying to identify if you're in a tightening range or a broadening range, what you can do is try and candle blend, which just means you kind of add these two candles together in your head. So you'll see you have this candle's low to this candle's high. So you can imagine that is one candle, and then you can combine these two candles together. So do you see how this candle fits completely inside the bigger candle? And then now you have another candle. So it's just kind of training your eyes and blending to see a different perspective. If we went to a 2-day time frame, you'll see that we're completely inside this 2-day candle. So the way to trade this is you have double inside days. So tomorrow, this could potentially trigger a what? A 2-1-2 down that could finally get it out of this mother bar. And that's why inside day break plays work, because there's consolidation happening inside of this range. This is consolidation. So the market hasn't picked a direction yet, but when it does, everybody's pretty much kind of on board. And again, like I mentioned in the last episode, get used to finger doodles, because it's not the lines that we care about. It's the price action, right? We only care that we have lower highs and higher lows. And when that breaks, that's when we want to join, not before. So don't diddle in the middle or play in the no-no zone. All right, catch you on the next one. Hello, and welcome to Stratucation Lesson 9. Today, we are going to be talking about multiple time frame analysis. So everything that we have learned so far is all based off of single time frame analysis. And what I mean by that is everything was just using one time frame. So that's full time frame continuity, where you are in relation to the candles open, your entries, your exits, your stops, when you're at possible exhaustion risk, broadening formations. So today we're going to kind of put all those pieces together, and the strat can be as simple or as complex as you want it to be. Now, single time frame analysis, in my mind, is simple strat. Now, it gets much more detailed and intricate when you start incorporating multiple time frames into your trading. And the benefit of this is you still get the higher time frame entry and targets, so the higher time frame magnitude, but on a smaller time frame entry, therefore lessening your risk. So, for example, I have the weekly chart of BA. And if you look over here, we just made a new high compared to this previous high. So this puts us at potential exhaustion risk. Why? Because we hit our upside target. So you can go back to the exhaustion lesson if you need to. So what that means is we should be looking for a potential reversal since we have exhausted and hit our target. So when you identify a reversal setup on a time frame, so in this case, I am seeing a potential bearish rev strat. So an inside bar, a 2 up that didn't go anywhere. So now I'm looking for the 2 down. And again, that is this guy. Remember, the right side of the chart is the bearish setups. When you're at upside exhaustion, you're looking for bearish reversals. So this is the weekly setup that I'm watching for. And per the lesson on stop losses, your stop could either be way up here, or it could be 50% of the weekly candle using only just this one time frame. So with a weekly candle, your stops have to be a bit bigger. So they're either up here, let me zoom in real big. They're either at the top of this candle at 178.46, or they're at the 50% mark at 174.59, okay? Now, where we get surgical strat is when you have a weekly bearish setup, it benefits you to go down a time frame. In this instance, this is pretty much your standard time frames. And this is pretty much how you should go down to see if you can spot a bearish smaller time frame entry. And what we're hoping to do is to take a smaller time frame entry to lessen our risk, but still get all of our reward. So what you need to be doing when you have a setup, you want to mark your trigger. So you know you're at possible exhaustion up here. You didn't get a reversal. We are possibly going to get our first reversal here. So that is our bearish trigger. So you want to have that marked on your chart. You want to have your target marked always. Because when you go down a time frame or multiple time frames, you will get lost and you won't remember what's what. So it's so important that you have your weekly trigger, like you can see on the right side here, your weekly target 1, weekly target 2, okay? Then again, we're gonna go down a time frame because we're looking for bearish actionable signals on the daily to trigger the bearish weekly actionable signal. So if you know the strat combo sheet, which you should have it memorized by now, it's only basically inside bars and down, or 2 ups, 2 downs. So we have this bearish daily setup that could potentially trigger the weekly. And what that does is it actually gets us in before the weekly triggers, because we're always forward thinking. If the daily triggers, can that trigger the weekly setup? So we know we're already at exhaustion up here. We know we have a weekly rev strat. So here is your setup. So knowing that you're bearish on the weekly chart, you're looking for bearish daily reversals to trigger the weekly. And the weekly is this orange line right here. And you should color coordinate your time frames. So for instance, what I mean by that, my daily color is always white, my weekly trigger is always orange, and my monthly trigger is always pink. So I know what is happening and I don't get lost in these smaller time frames. So you stratter, think to yourself, if this 2 up, 2 down triggers, can that trigger the week? So what you will do as a stratter is you will go short here with a stop. You can use 50% of the candle, which I know it looks like it broke, but it didn't because this action happened before we went 2 down on the day. So what this does is now your trade to trigger you in early to the weekly is your short at 174 and your stop, we'll call it 176. So you have a $2 risk. And then once you can leave your stop here if you want. If you're more conservative, you can bring your stop down a bit to get you maybe only $1 risk, because once it's down here, it really shouldn't come back up here because we're expecting to trigger the week. Now, if we go back to the weekly, even using the 50% rule, so your weekly entry would be at 171 and your stop would be at 174.50. So you have a $3.60 risk using the weekly. And if this works, we're going to come all the way down to here because that's the weekly target, right? So let's go back to the daily real fast. And we're going to ignore this stop all the way up here. That was a weekly stop using the high of the previous week. We want the less risk and most reward. So if we get our short position tool, our risk is here. Our reward is here. So this is a 2.6 to 1, and it gets you in early. And then again, like I said, you can always move your stop to be a little bit tighter because it really shouldn't come back up into here. And then you get like a almost 6 to 1. But if it's going to go, it's going to go. Now, if you're using the weekly and you're not entering until the weekly trigger and you're using a 50% stop, this really isn't probably worth the trade, is it? No, it's less than 1 to 1. And that's what multiple time frame analysis can do for us. So do you see how putting all the pieces together, exhaustion risk, can't just short when you hit a new high, you have to wait for a reversal. But then going down a time frame and saying if this daily bearish reversal works, so it could be anything on the right side of the chart. If anything on the right side of the chart occurs, you're going to enter, anticipating or hoping that you will trigger the weekly rev strat. So I am always looking for reversals to trigger my reversals. So yes, I have a potential weekly reversal, but I don't want to enter only on the weekly time frame. I want more control. So I go to the daily and I look for a 2 up, 2 down. Boom, I'm entering. So less risk, but more reward. Another great example was coin. This had 3 time frames that triggered one another. So if you look here on the quarterly chart, we had, it's not much magnitude, but the setup was still here. You had a 2, 1, 2 down. So knowing what you know about the strat combos, you know the quarterly, oh, my quarterly lines are turquoise. The quarterly trigger is here and the quarterly target is here. Okay, so then go down to a monthly time frame. What do you see? We had double inside months. This was a trade we actually took. Is this a bearish actionable signal if we get a 2 down? Yes, it is. This is multiple inside bars, but it's still treated basically as an inside bar break. So we had this monthly inside bar. So when this month opened, we knew that if we triggered the inside month and down, that could potentially trigger our quarterly setup, and then we could potentially hit our quarterly target, which I know it looks like hindsight now, but it was very much foresight. We did this in real time. Then if you go down another time frame to the weekly, you know that that's your monthly trigger. So pretend none of that exists yet. You know that this is your monthly trigger. This is your quarterly trigger. It's a bearish setup, obviously. Then we got a weekly bearish 2 up, 2 down. So we knew this was the week that we took it. If we take this 2 up, 2 down week, can that trigger the monthly? Can that trigger the quarterly? And can we hit our target? And the answer was yes. Go down to a daily time frame. You can always find an entry here. Even if you missed the weekly entry, you can wait for daily corrective activity, and then you can short on a bearish reversal. 2 up, 2 down, that is your daily trigger. So you had all these factors working together. You had the weekly triggering, the monthly, you had the daily reconfirming the week and the month, triggering the quarterly, got a bit of a bounce, but boom, ultimately hit our target. And knowing all this, you could have quarterly magnitude, but using a daily entry and stop. You could use, again, a 50% stop or a stop at the high. Those are your options. So lesser risk, greater reward. Next lesson, we will be talking about the abbreviation that I can't stand, TTO, and you'll know why on the next lesson. See you then. Bye. Hey guys, welcome to lesson 10 of Stratucation, TTO, triangle they out, or I like to say triangle they're out, but in fact I don't like to use this term at all because I find it very confusing. When Rob says triangle they out, he is referring to the trader on the opposite side of your trade getting stopped out. There really are only 2 types of ways that I like to look at this. You either have an exhaustion reversal because you've hit your magnitude, or it's corrective activity because you haven't hit your magnitude yet. Either way, it's a move in the opposite direction of time frame continuity. If we look at Netflix on the daily chart, we have a perfect storm for a reversal to the upside because we just hit downside magnitude. So we know that puts us at potential exhaustion risk. And simple strat, we mark our daily entry and our daily target. As you can see, this trade played out. Now, for the more surgical strat and people who want to use smaller time frames to have more control over their entries and stops, we have to have these on our charts, our entry and our target, so we don't get lost intraday. As much as we wish price would just go straight up from our entry to our target, that doesn't happen. So you'll get little pullbacks along the way. These little counter trend moves tend to be just healthy corrective activity because we have not hit our target yet. And as long as it doesn't change the higher time frame continuity, so we know that anytime we're above the daily open, the day is green and we want to be trading in that direction until we hit our target. And this is why we use the strat combo sheet to enter after pullbacks have happened, because we don't just want to be buying in at the tops like breakout traders do. We want to wait for corrective activity because we know it's going to come, and then we want to get in, and then we can trail our stops down on the higher lows, right? In a perfect world, in a nice uptrending day. So I would like for you guys to think of it as, if you haven't hit your daily target, these little pullbacks or TTOs are just corrective activity and an opportunity for you to get in and ride up to your target. So here's the 5-minute chart, and then over here is the 1-hour chart. And you can see when we triggered the day, we just went straight up, and then we hit our daily magnitude, right? So that's when we're at exhaustion risk, because we hit our daily target over here of 293.57. That's when, if you get a reversal against you, you want to fully exit your long if you haven't, because you know that you've hit your target, and then we got an exhaustion reversal. So you would just want to exit here no matter what. So this is a great example of an exhaustion reversal because we hit our target. And these little guys are examples of corrective activity, aka pullbacks, because we haven't hit our daily target. So here are just little pullbacks here. And then once you've hit your daily target, that's when you know, hey, this could be the very top, and you got a really beautiful reversal. The first reversal after hitting your target was right here. So you could have exited there. If you hadn't exited your full position at your daily target and you wanted to keep a runner until you get a reversal, and then boom, out right there. Let's look at the 15. So we know the daily trigger's here, daily target is here. Any pullback or bullish strat combo setup is an opportunity for you to get in until your target gets hit. So here you have a 2-1-2 up. You could get in here. You had a failed 2 down, go 3. You could add here. You had a 2-1-2 up again. You could add here. Target hit. Now you're at upside exhaustion. Here's your 15-minute reversal. You could also have exited right here. This chart gave a lot of good exhaustion reversal levels, right? So we had this hourly one at 293. You had a 15-minute one at 294. And you had a 5-minute exhaustion reversal at 295. Here's a 10-minute chart, which looks even more nice than the 15-minute chart. We wait for the pullbacks to happen because we don't want to get in up here and then we know a pullback's going to happen eventually. Why would we want to be in here and sit through all this downside? Why don't we just wait for the pullback to happen? Then we get in. That's the whole reason why we trade reversals. So this is a 2 down, 2 up, okay? You have another one right here. So that's a second entry. 2 down, get in at the 2 up. Then you have a double inside bar to the upside. Again, anything on the sheet is actionable. So this is sort of more like continuation, but still actionable. And then boom, target hit. So in closing, you won't often hear me talk about TTOs. I'll either say exhaustion reversal or corrective activity, which is a pullback. And in a downtrend, the corrective activity is more like a snapback. When I'm talking about a downtrend, I'm talking about a counter trend move. So all these little bump ups, aka bear flags. That's corrective activity. Another thing I wanted to add, when your daily target is up here and you have this nice uptrend and you're experiencing TTOs or pullbacks, one thing I want to mention is you don't have to hold through them, because you hope that they're shallow, healthy pullbacks, but you really don't know how deep they can go. And our job as a trader is to protect our gains and to protect our capital. So let's say you entered this trade from this 2 down, 2 up, and you know your daily target is up here, okay? Well, even though you have more magnitude on the daily, you can always cut your position here because you don't know how deep this retracement might go. So there's no shame in cutting it and then re-entering when you know you still have more magnitude ahead. So you don't have to hold through these. Some people use these as an opportunity to add, but again, what if it pulled back all the way to here and now you're back to break even? So you don't have to, right? So you could cut here when this went 2 down, and then you can simply re-enter right here, and you're not missing much profit at all, but you're protecting all the profit that you did make. Same with right here. You have 2 up, 2 up, 2 up, 2 up, 2 up. When does that stop? It stops right here. You get a 2 up, 2 down. Again, you can cut your position and wait for another signal. And let's look at what that would have looked like. You're only missing 10 cents of profit if you held through all this, but you're also protecting all of that possible drawdown and pullback. Then your target gets hit. So TTOs are great for locking in profit, being patient, and waiting for a setup to materialize again. So hope that helps. Hey guys, welcome to lesson 11, which we are going to call the big picture and zooming out, because people tend to love to do this. They have the daily time frame and they go, Sarah, I have a pivot machine gun set up on the daily. What do you think? And to me, the daily time frame is trading blindly. If you're only looking at one time frame, I have no context for this trade. I don't know if we're at exhaustion risk. I don't know where we are in the broadening formation. I don't know if we have full time frame continuity. I don't know anything. So when you are trading, don't get sucked into single time frame analysis. This is not enough information to base a trade off of. I don't care if you're a day trader or a swing trader, you need to have multiple time frames up. You need to have the bigger picture in mind. Because people will see this like, oh, Sarah, this is a pivot machine gun to the upside. Well, yes, it is, but not all pivot machine guns are created equally. We only want to trade pivot machine guns when we're at downside exhaustion in this case, or on the bearish side if we're upside exhausted. So when people just post this, like, oh, we have a 2 down, I'm looking for the 2 up. Do you think this will work? And I'm like, I have no idea. There's nothing on this chart that would signify this is okay to take. So let's look at it. So we have a doji 2 down day. If you were trading in full time frame continuity, meaning the month, the week, everything was green, yes, you could take this. The trigger would be 86.61, the high of that candle. Target 1 is here. Target 2, target 3, you get it. It's a pivot machine gun. But is it an okay pivot machine gun to take? Well, I don't know. We have to go into the higher time frames. So this is Amazon daily. So what I encourage people to do is have 3 time frames up. I always have the month, the week, and the day, because this gives me context. Now, even though I'm a day trader, I am still starting at the monthly time frame. This is my big picture analysis. So I want to know where price is going. So based on the monthly time frame, I know that we are coming to take out this pivot. Okay. So that means the month is red. So we have full time frame continuity to the downside. And this is our target. Our target is 81.30. That's this candle's low. Okay. That is where the draw on liquidity is and what the target is. So when we're trading up here at 86, why would I want to take this to the long side knowing that we're most likely going to head lower? And if this does trigger to the long side, this is more than likely only corrective activity, and I should not expect my target to get hit to the upside. I should not be taking this to the long side. I should be waiting for a 2 up to be corrective activity. We just talked about corrective activity in the last lesson. Corrective activity happens usually before you hit your target. So our big picture target is bearish and to the downside. So we don't just want to take this trade. This would be a very low probability trade, right? So I want people to zoom out, get the bigger picture, trade with the trend. Even though everybody wants to be a bull, you can't be a bull in a downtrend. It's just that simple. Okay, so let's see kind of what happened. So the next day opened right here, triggered the 2 down, 2 up day and failed. And why is that? Because we're in a downtrend. You can expect corrective activity not to hit target because it's counter trend. It's against the trend. The bigger trend is down here at 81.30. So you, knowing this, knowing that 81.30 is your target, you don't take the long. You take the shorts back down. So zoom out, get your bigger picture. Okay, the following day, what did you get? You got a 2 up, 2 down that went really far, okay? It hit your target one and then kept going. We didn't quite hit the yearly target. We came really close this day, but the point of the story, zoom out, know your higher time frame targets. Don't trade a chart or try and place a trade solely on the daily time frame, super zoomed in, because you're going to get killed. If you look right here, here's a 2 down, 2 up bullish reversal also that also didn't hit target. Because why? Because we're in a downtrend and our bigger target is 81.30. We came within 13 cents of it on the year. So I hope this resonates with some people. You cannot just trade on the daily time frame. If you are trading only on the daily time frame, that tells me that you don't know the strat and that you're only trading this sheet. In this sheet, I refer to as the tip of the iceberg. The strat is so much more than this. It's multiple time frame analysis. It's time frame continuity. It's broadening formations and knowing where you are in the broadening formations, knowing where you are in full time frame continuity, trading with the trend. So don't get so sucked in to a single time frame and completely lose the big picture. This is probably the number one mistake that I see new stratters making. They're only looking for setups and completely ignoring everything else. That will get you killed, I promise. So zoom out, know the bigger picture, know where you are in your broadening formation, and make smart choices about the trades that you take going forward. All right, catch you guys later. Hey guys, welcome to lesson 12 of Stratucation. Today we are going to talk about risk reward, because it's something that I feel like traders, when they start learning the strat, they completely forget about. And not all setups are created equal. You want a trade that has decent magnitude on it, so meaning profit potential versus risk. And we don't just want to get excited because we see a setup. We want to know what our risk reward is for taking the setup. So I'm not going to get into all the reasons why I would take this short, because it's just everything to do with all the strat principles. And we're looking to take this short to come back down to the bottom of the Broadening formation. So TradingView has this really cool tool. If you go over here, see where my mouse is on the left side of the screen, you can pick if you're looking at taking a short position or a long position. So what you do, click on it, put it on your entry, and then move your target to your target and where your stop would be. And what you want to see, you want to look at this risk reward ratio. A 1-to-1, it just means you're risking, $5 to make $5. That's not great. So typically I try to stay more in the 2-to-1 area if I can. Okay. So just using this and using a 50% stop based on the stops on the strat combo sheet, your risk is 0.95. So it's not even 1-to-1. So this isn't great, right? So 0.95 to 1. So this might not be a setup you would take, okay? But what if you could go down a time frame and see if there's an earlier actionable signal to take, okay? How does that change your risk reward? So the next smallest time frame from the daily would be the 4-hour. Not the 12-hour. The 12-hour is a daily chart, okay? But if you look here, we have a potential 4-hour early actionable signal to get us into the daily trigger sooner. That makes this trade worth your while. This is a 2-to-1 risk reward using the whole candle as your stop, or you could also use a 50% stop, which is 2672, about there. So this changes your 4-hour risk reward to a 4.3 to 1. So basically you're risking $1 to make 4. And once you know your risk reward, that's when you can get really detailed with the settings of this tool. So if you click on it, you hit settings, you tell it your account size. So say, this might be a lot, but say you have a $50,000 account, okay, and you don't want to risk more than $500, which is 1% of your account on one trade. Okay, plug that in. So this tells you that you can purchase or short 2,380 shares with this risk reward profile. But if your account's at 50,000, it's showing you have a $500 risk, because 50,000 minus 500 is 49,500. And then it's showing you from your $50,000 account, you have the potential to make $2,200. And then you can just change these for whatever your account size is. This is for common. Now, if you wanted to trade options, you would just risk $500. So you'd have to buy however many contracts to stay under a $500 premium purchase. But the risk reward is essentially the same, with it being 4.3 to 1. Obviously, you're going to make more percentage-wise with options, but this is what you need to know how much to risk and how much you can gain. And is it worth it? The main thing is this risk-reward number. You want to, again, try to stay closer to 2 to 1. If you can get 4 to 1, that's excellent. That's what we hope for. And I'm going to show you how this played out. So what happened was The day opened here, triggered your 4-hour setup, triggered the daily setup, and hit target. And again, I am always screaming at people to take profit at your targets, because this is then what usually happens. You usually get a huge move in the other direction. Targets are our targets for a reason. That's the end of your trade. You should be out when your target is hit. If we go down to a 15-minute time frame, you'll see that your stop did not get hit before your target did, even though this candle closed higher than the stop. I'll show you. Okay, so right here on this 15-minute candle is when the 4-hour triggered the daily setup, then hit the target. It happened in the first 15 minutes of the day. Boom. So in here, exit here, and you're good to go. Okay, here's an example to the long side. So you have Apple, your daily trigger here, your daily target here. We're gonna get the long tool. We're gonna use a 50% stop, which is 135. And your target. Okay, so what is this risk reward? This is a 1 to 9. Okay, not bad. But can you go down to a smaller time frame and find an earlier bullish strat setup? What do you have here? You have a 4-hour, 2 down, 2 up to trigger that daily setup. Okay, so what does that look like? Okay, so the daily was a 1.9 to 1, but using the 4-hour to trigger the day, this gave you a 2.8 roughly to 1. So you can use bigger size because you're risking less. So in this instance, you can buy 163 shares, but on the daily, you could only buy 120. So see how you can lessen your risk, but still get all the reward. That's the strat, baby. That's why it's so powerful, and why complex strat and multiple time frame analysis is so much greater than single time frame analysis. We just look for bullish setups to trigger daily bullish setups. And again, that's on lesson 9. Love this tool. Oh, see, so this was actually a different risk reward. I didn't change it, but so this would be a $30,000 account risking 0.5%. Still pretty awesome. All right, that's it for now. Bye. You guys, welcome to lesson 13 of Stratucation. And this lesson is called Putting It All Together and Finding Strat Setups. So in lesson 11, we talked about zooming out a bit, and that lesson is going to play a role in this lesson. And if you've watched all the lessons so far, you have learned that the strat is far, far more than just the strat combo sheet, right? The strat is so much more than just this. There is so much more context and principles behind why we do the things that we do. So I took the Stratucation lesson plan and I copied it on this sheet, and I kind of turned it into a checklist, because the most important thing is, why are you taking this trade? You cannot just take a setup on the strat sheet just because you see it. There has to be context. You have to have higher time frame context. You have to have all of this context, and we're kind of going to go through it. So why are you taking this trade? Is it a domino effect? Will this actionable signal trigger a higher time frame actionable signal? multiple time frame analysis and magnitude. Is the higher time frame in force, and does it still have magnitude left? So with this, say the weekly is in force and hasn't hit target, and that's okay, and you're going to trade a bullish strat reversal until the higher time frame hits target. So that's acceptable as well. TTO. So has the chart had corrective activity recently and is setting up an actionable signal back in the direction of full time frame continuity so it can continue on and hit its higher time frame magnitude? Full time frame continuity. Are you trading with full time frame continuity and the surrounding time frames are the same color? Are you trading against full time frame continuity? And if you're trading against full time frame continuity, you know you can only do this if the price has reached an exhaustion level and you're attempting a counter trend exhaustion reversal. Same thing with broadening formations. Those are counter trend trades, but they are at exhaustion risk. So are you seeing a potential exhaustion reversal at the top or bottom of a broadening formation? You must be mindful, though, that you are trading counter trend, and if you're wrong and it doesn't want to go, you have to be prepared to stop out if it doesn't work. Trader style. Do you even want to trade exhaustion reversals, meaning at the top or bottom of a broadening formation or at price exhaustion? Because those are against full time frame continuity. Some traders only play when they have full time frame continuity, and that is totally fine. So if you're a bull and you only want to trade when the month, week, and day is green, that's fine. And then you know you're not taking any bearish strat setups. You're only looking for bullish setups. That's fine too. So you have to figure out who you are as a trader and what you like to do and trade it that way. Exhaustion risk. Are you trading something on a smaller time frame that has already hit its target objective on a higher time frame? So is the setup you're looking at already at exhaustion? Because if it is, it's already done. The trade's done. Tightening ranges. Are you trading something that is stuck inside on a higher time frame and unlikely to move? Are you trying to trade a daily setup, but it's still inside the previous week on a Friday? On the last day of the week, it's still inside the previous week's range. You don't want to be trading something like that. It's stuck. It's not going to go anywhere. Risk reward. Is the risk reward worth taking the trade at all? Is the potential reward bigger than the risk? Okay, so back to lesson 11 and the big picture. So what I do is when I'm looking for strat setups for the following day, I am using 3 time frames. All of my day trade ideas come from higher time frame context and strat principles. So when I'm charting, I am using the month, the week, and the day. And in my opinion, one time frame is not enough to get the big picture. Because if you're too zoomed in, you're not going to see if price is at exhaustion, if it's got more room to go, it hasn't hit magnitude. It's too hard to tell. And me personally, I want my actionable signals on whatever time frame to trigger a higher time frame actionable signal, and that is the domino effect that we learned about. And what's cool about the domino effect is this way I have full time frame continuity in my favor, and I also have 2 participation groups. So usually the daily and the weekly players, they're on my side. Everything's going in my direction. We want as many things in our favor as we can get. So when I have a daily actionable signal triggering a weekly actionable signal, that is excellent. I have 2 different set of traders playing in my direction. And this also means if I have a setup triggering a higher time frame setup and going outside of the previous week, it means that I can get nice, big, large trading ranges because I know we're not confined to a small little area. And all of my daily setups come from higher time frame context, but I have a clear directional bias on all of the strat principles. And it drives me nuts when I see people on Twitter saying bullish above this level, bearish below this level, because that tells me that they really don't have the context. They're just going to trade either way. And that's exactly what you don't want to do when you see an inside day setup. You don't just want to trade it either way. You want to trade in the direction of your higher time frame bias. Because sometimes if you're not, they're just not going to hit target. And the reason is if you're trying to trade a bullish 212, but you have every reason to believe the chart's going lower, you would prefer to trade a 212 down than a 212 up, because you know if you're trading a 212 up, but you have full time frame continuity to the downside, you are longing a TTO. So you're just longing corrective activity. And we talked about that in another lesson, how corrective activity, you cannot expect a counter trend corrective activity move to hit the target. I am predominantly like 90% a day trader. But this same exact method and same exact questions work for higher time frames and for swing trading. Instead, you might use just higher time frames. You might use a quarterly, monthly, weekly, or you might use a monthly, weekly, daily, or if you're even slower time frame based, you might use a year, a quarter, and a month. It all depends on what you like to trade and what time frames you prefer to trade on. So I have two examples of trades, and one I would favor over the other, and we're going to talk about why. And everything is based on the strat principles. So, for instance, we're going to pretend that today's price action did not happen yet, okay? But I'm sitting at my desk, pretend I'm sitting at my desk last night, and I'm trying to find actionable signals to trade in the morning, okay? So let's say this triggers a 2 up, 2 down daily reversal. Okay, if you're so zoomed in that all you can see is like this much price action, you're doing such a disservice to yourself and to the strat principles. All right. So why wouldn't I have taken this to the short side? So first of all, starting with the monthly, the month is bright green. And I know it looks like it hit magnitude, but it didn't. It didn't by 10 cents. So if you look on the weekly, you can see this little gap between this candle's wick and the target. So I am not exhausted. The month is green. I do not have exhaustion risk. So why would I want to take a bearish setup when I know that we are trying to reach for 64.44? I wouldn't want to. Instead, what I would want to do is sit this day out and then wait for a bullish 2 down, 2 up, because my higher time frame context tells me we're going up here. So if I had to pick between this chart and the next chart I'm going to show you, I would not pick this one because we're not at exhaustion and the higher time frame tells me higher. We actually have 2 targets higher. I'm not going to pick this one, and you'll see why when I go to the next one. So this was MU on the day. XOM. Okay, let's first start off at the monthly. Now, the monthly is green, yes, but did we hit exhaustion risk by making a new high? Yes, we did. So we are at all-time high exhaustion risk because price took out the objective. So the monthly objective of this setup, a 2 down, 2 up, is to take out the high of the 2. So we did that. So what does that mean? That means that we're at potential exhaustion risk. Okay? And that line, that exhaustion line, shows up on all my charts. You're going to have to ignore this big wick. The whole market had a huge issue this day with price. So we're going to pretend that wick doesn't exist. But so if you look at the daily, I know that we're at exhaustion risk, which means when we're at upside exhaustion, what are we looking for? The answer is bearish strat setups. So anything on the right side of the sheet, or the 2-sheeter in this instance. Okay, so what do we get? We get a 2-1-2 reversal. Would I take this? Yes, I would, but I also know I'm trading against full time frame continuity, but it's okay because I'm at exhaustion risk. Now, this trade hit magnitude. Target 1 was there, and then target 2 was a gap fill, which also hit target. So on this chart, even though we had full time frame continuity to the upside on the year, quarter, and month, I know that, but I'm a day trader and I'm looking for strat principles to tell me that it's okay to try and short this. So again, we had all-time high exhaustion risk. So for me, it's okay to try and short this. And I would never know that if I was this zoomed into the chart, right? I would just say, oh, this looks like a nice healthy uptrend, and not want to short. But we have strat reason to short it because we are at exhaustion risk, and therefore we can play exhaustion reversals. Now to go back to MU, we are not at exhaustion risk because we did not take out our long objective, which means we should not really be looking to play shorts because we know that price is going to want to come up here. Okay, here is a swing trade example. Now this month isn't technically closed, nor is this quarter closed, but here is the potential setup for the quarterly chart. Okay, we had a 2-1-2 down that hit target. Okay, the new year and new quarter opened, triggered down, came back up green. So what you have here on the quarterly for a potential actionable signal, because this quarterly has 2 months left, is a potential outside quarter, right? Because it already fits the requirements of triggering one side, turning around, going the opposite direction, retracing 50% or more. So we would target up here. So this is an actionable signal on the quarterly. That's our higher time frame context. So we're going to look for actionable signals on a time frame down. So on the monthly. Now we don't have an inside bar, so that one's out. We're not closing the month inside. We're closing the month as a 2 down. So that only really leaves the potential for a 2 down, 2 up monthly reversal. So you say to yourself, you know that your quarter is a potential outside month, and as long as we're above the 50% line and you have an actionable signal, you can take it. So you say to yourself, if this 2 down, two up triggers, that's actionable because your smaller time frame actionable signal can reach your higher time frame target. So say we close right where we opened. You would expect that to happen next month, creating an outside month and on a bullish actionable signal. So it works the same. You still need to use multiple time frames though to get your context, because if you didn't have an actionable signal on the quarterly, do you really want to be trading the monthly? But then you could also look at this as potential bottom of the broadening formation, and we're going to go and try and take out the highs after taking out the lows. Okay, we're going to do a little drawing to kind of cover what I'm talking about when I'm saying these things. So will an actionable signal trigger a higher time frame actionable signal? So pretend this is a weekly chart and you're expecting it, the next one, to be a 2 up. So you got a 2 down that closed near the highs and you're expecting a 2 up. So say the daily sets up a 2-1-2 bullish because our bias is up because we're looking at the weekly time frame and we know that we had a 2 down that closed at the highs. So the next logical 2 would be a 2 up. So on the daily, you find a strat setup before the trigger that can trigger the higher time frame trigger. So that's the domino effect trade. Okay? And you want the week to end looking like that. But you take a daily actionable signal to trigger the higher time frame actionable signal. Okay? So multiple time frame analysis. Is the higher time frame in force and does it still have magnitude? Same thing. You have a weekly 2 down. You're looking for a 2 up reversal, but maybe the first day goes there. Then you get a 2 down. So we're visualizing the weekly, but trading on the daily. But ideally, you would have these charts up side by side. But maybe you don't enter on the weekly signal. You wait for a daily actionable signal. And then you get a 2 down, 2 up on the daily to reconfirm the 2 down, 2 up on the week and hopefully hit target. So you can get in them before the week triggers or after the week triggers on a smaller time frame. It all depends on how you want to do it. There's no right or wrong way. One is just already in force and one you're anticipating it to go in force. And then full time frame continuity, just are you trading if you're bullish in a giant uptrend? And if you are, you don't want to take the strat short setups. You want to let those play out and then you want to wait till you get a bullish strat setup, or vice versa if you're trading to the short side. And then you all know when things are at exhaustion. So in summary, when I'm looking for my day trading setups, I'm using all of these time frames and all of the strat principles to formulate my bias, where I think price is going, based on exhaustion levels. And SPY, for example, today, or SPX, whichever, I did not want to take this 2 up, 2 down because we aren't at exhaustion risk. We didn't take out the highs. We didn't meet the upside objective. So I'm not trying to short this, right? Instead, I would look for the bullish setup to materialize because I know that's the higher probability trade. I don't just want to be taking setups when I see them and I don't have reason to be taking them. So I hope this helps. Catch you guys in the next. Hey everybody, welcome to lesson 14 of the Stratucation course. Today we are going to talk about gappers. And in my opinion, gappers is a strategy more for advanced stratters and not so much the new stratters. And the reason for it is because they're very volatile, and it's kind of a strategy all on its own, because these do not have daily actionable signals or daily triggers, because they can't, because what happens is a gapper usually jumps so far up or down from the previous day's close that there is no actionable signal. Gappers occur usually due to a news release or earnings, and it's a big shock to the system. And for me, for it to be a real gapper, it must open nowhere inside the previous day's candle. So it cannot open between the high or the low of the previous day. So there must be a gap, if you will, of space between where the stock is opening and where it closed the day before. So where this day closed and this day opened, there is that blank space on the chart. So to me, that's what I want to see. You don't want to see it open inside the previous day, otherwise it's not gapping on the daily chart. So since there is no daily actionable signal to trigger you into a trade on a gapper, gappers are heavily dependent on other strat principles. So the ones that you really want to kind of focus on are daily time frame continuity. So what color is the daily candle? Exhaustion risk, and then intraday actionable signals. So if you look at Uber on the daily chart, the previous day closed right there at 34.90. Okay. And then we opened up here. So I know, try to envision this whole candlestick doesn't exist, because all you know at the open is that you're opening way up here. Okay. So when you're playing a gapper, you always want to look left on the chart to see if you're at potential exhaustion risk, because you've hit some sort of important pivot high. So we will label this potential exhaustion risk. So we gapped up, we took out that high, okay? And then we know, based on the lesson on time frame continuity, where you are relative to the candle's open determines if the day is going to be red or green. A general rule of thumb for gappers, and of course, a rule of thumb is just that. It doesn't happen 100% of the time, but a general rule is that gap ups are for selling and profit taking, and gap downs are for buying and accumulating. And why would that be? And if you think about it from the position that you're the trader, and say you took a gamble that Uber earnings were going to go up, so you bought, a lotto call. Well, when the day opens and you were right and it went up, what do you as a trader want to do? You want to lock in profit, right? So you're going to sell your position, as are most people, because they got what they wanted. The chart gapped up, they were right, they're exiting their positions. And same thing with the short side. If you were betting that Uber was going to gap down because of earnings, and it did, what are you going to do? You're going to close your position along with people wanting to buy the dip. So that is the general rule of thumb. Gap ups are for selling, gap downs are for buying. However, daily time frame continuity is going to let you know if that's happening or not. Because on a gap up, you want to see a red candle. On a gap down, you want to see a green candle. And why do people want to play gappers? So the more advanced people want to play gappers because they tend to be very volatile and move a lot, especially if you're in a low volume, low volatility market where things aren't moving that much. you can always count on the gappers to provide you some volatility. Gappers also tend to be more of a day trading / scalping strategy, but sometimes if you get a really good one, you can enter a position and hold on to it all day if it's just going to keep going. So a small day trade can turn into a whole day trade if you get a good entry and you have a clear target of where you think price is going. And speaking of targets, most targets when you're playing a gapper are going to come from intraday price action because there's no really other price action around. So it's going to come from your actionable signal strat setups on the intraday smaller time frames, right? And then another target methodology is the gap fill, because we know the market doesn't like to leave holes, so it's going to want to come and fill this hole, because remember, this whole candle doesn't exist. It opened here, and then throughout the day it's going to build its price action, and then a gap fill target is always a major target for gappers. Now, if you're a pretty advanced stratter and have fast executions, you can trade reversals or strat setups in the direction of daily time frame continuity on the 5-minute chart if you want. And for the not so advanced stratters, I would recommend you stay on the 15, 30, and 60-minute charts. So let's kind of dig into this chart a little bit. So we already know that we gapped up, we opened up here, we know we're at potential exhaustion, okay? And then we know that anytime we're below the open, the day is red, and we want to be trading to the short side because we have upside exhaustion, and we know that when we're at upside exhaustion, we're looking for bearish exhaustion strat setups. Okay, we know we have a gap fill target. Okay, so let's go into the smaller time frames and see what we can see. Okay, here we have the 5-minute time frame, and the previous levels from the daily chart are still on this chart. So that was our exhaustion level, and this was our gap fill target. So again, knowing that we're trading below the open, we want to be looking for bearish strat setups because we have daily time frame continuity that is red. So we want to be trading with that knowledge. All right, so what is the first bearish strat setup that we see? This is a 2 up because technically it broke the high of the previous candle. What is the very first short bearish setup that we have? If we go to the sheet, we're looking for the bearish. We have a 2 up is the first, that would be our trigger candle. So this is a 1, doesn't apply. This is a 1, doesn't apply. Here we go. We have a 2 up. So we need a 2 up and then a 2 down. So this is the strat setup that is very first offered to us. Okay, so you're in on the 2 up, 2 down. We have no other nearby targets, so we kind of have to default to the gap fill, right? What's the second? You have 2 down, 2 down. These are not actionable. 2 down, 2 down, 2 up. So here's your corrective activity, right? A counter trend move, and it's counter trend because we have red full time frame continuity. So this is corrective activity. Okay, then what do you get? You get an inside bar. Is an inside bar an actionable signal? It is. What is it? It's a 2, 1, 2 down. So we know that our entry is below the 1. Okay, so our second entry is right here. Our target is the gap fill, okay? Which you hit right here, which means you should be all out right here. 4.5% or $1.66. Okay, here I want to talk about a gap fill and then go. So Tesla on the day it did gap. So we closed the day here and then we gapped here, which means on the open, there was a gap of air on the chart that looked like this. You have to look at this candle and imagine the life of it. So it opened here and that was it. So all you know on the open is the open. So you don't know if it's just going to fall apart or if it's going to want to go and fill that gap and then fall apart. And here's a good example of a gapper that you can find targets other than gap fill targets by looking left on your chart and getting your targets from the daily candles. So obviously, if you are of bearish bias, your targets are going to come from candle lows. And if your gapper is bullish biased, your targets are going to come from the candle highs. All right, so here's the 5-minute chart of Tesla. We already know that that was our daily open because we marked it from the daily, and we know that that was our daily gap fill. Because I want you to imagine in real time. So the day is here, the daily open is here, and the daily color at that time was green. The first strat setup was a bullish 2 down. This is a 2 down because we broke the downside of the previous candle, and then a 2 up. Okay, that is actionable. However, it failed. So this is telling you and showing you that the ability to push higher is being rejected. So you have to be prepared to stop out. So your stop would be a 50% stop. Okay, and when you get this failed 2 up, not only are you going to stop out, you're going to flip short because you have a bearish setup. So you want to take this because the upside failed. So now you're switching teams, you're on the bear side. So now you want to go short. 2 up, 2 down. There's your trigger. Remember, we're bearish now because we're trading below the open. 2, 1, 2 down. Perfect, actionable. This got a little hairy, so maybe you had your stop here, top of that candle, or maybe you were walking your stop down the highs of the candle because we haven't had corrective activity yet since the top, since the high of the day. And we know that when we're in a strong trend, we want to see corrective activity, and then we can use a trend-based stop. This just went continuation, and every single candle had a lower high, so maybe you want to keep your stop tight because you know corrective activity is coming. Maybe you get stopped out here. This looks like 15-minute corrective activity, which you should be monitoring multiple time frames. But this 2 up, 2 down failed. You would have been stopped out when you went 2 back up. So what do? It's okay. You re-enter again. It back tested the daily open, and we're still trading under the daily open, so we still have full time frame continuity on the daily in our favor. So we're going to try again. 2 up, 2 down. This one works. Again, if you like, you can even trail your stops down each candle's high to lock in that profit, because we can always lock in profit, and then we can always what? We can always get back in. So again, gappers are volatile, so you want to take the gains while you have them. Be protective. It's totally fine to trail your stops to the highs of candles because you don't know how high corrective activity is going to go, and maybe you don't want to sit through it. Okay, so say maybe you entered here, you stopped out here, you let corrective activity happen, you go again. 2 up, 2 down. Now your stop, I would put at this trend-based stop because hopefully that's the top of the corrective activity. Trail down. Okay, maybe you get stopped out here because you're trailing down the 5-minute highs. Okay, and then you wait for another actionable signal. 2. It only broke the high by a penny. Maybe you got stopped out, maybe you didn't. It couldn't hold above it, so back down, boom. That was your daily target right here. Okay, here is QCOM daily. This is an example of a gap down. So on this day, the low of the day was here, okay? And then whatever, it had earnings, so it gapped down, and the daily open was here, okay? So when the day first opened, you had a gap or space of error on your chart. So this qualifies as a nice gapper play, okay? And then in the strat, what are we doing? We're always looking left and seeing if we're at exhaustion risk compared to where we're opening. And you can see you have this pivot low right here. It's the lowest candle of the surrounding candles, so that is a pivot low. So that is your what? That is your potential exhaustion level. Now we know, looking back, it opened here, it closed here. But how did the wicks happen? Okay, the wicks happened because it opened here, traveled down, took out the people who had stops here, and then reversed. Okay, so but knowing what we know now, how does that help us intraday? So you'll have to go into the smaller time frames to figure it out. So we know that this would be our gap fill, because remember, this part of the candle doesn't exist yet. Come the opening bell, all you know is that you're opening here, you have a gap fill here, and you have potential exhaustion risk here. So let's go to a smaller time frame and see what happened. So we had our daily levels marked. Remember, this was the gap. So we opened here. We know our exhaustion level. Remember, that was that pivot low on the daily over here. All right, so the first 5-minute candle opens. It does what? It travels down, hits that exhaustion level, wicks up, goes back above the daily open. So now the day is green. So what's your actionable signal? The first bullish actionable signal, because again, we're at downside exhaustion. So we're looking for bullish exhaustion reversals. You have a 2 down. So the only possible actionable signal, so you're looking in the middle here, has to start with a 2 down. So here it is, 2 down, 2 up. That's what we're gonna take. Okay, 2 down, 2 up. We have our gap fill target. Okay, so it hits that. You can take your profit all there if you want. And then if it's gonna keep going, you need to go and find other targets. And how do we do that? We do it by going to other time frames and looking for targets. And what do we know about targets? They are, if we're bullish, they're going to be the highs of previous candles as we look left. So remember, all this price action you're seeing doesn't exist yet. Okay, so you are forward thinking and plotting your targets, and you know that they're candle highs. So you're just going to place targets at each candle high, because it's important to know if you're going to hit your targets or if you've hit all of your targets and you're exhausted. Okay, so I'm back on the 5-minute chart, but I got my other targets from the 15-minute time frame. You can even get them from the 5, but I kind of prefer the 15 when you have that pivot machine gun look that we had. Okay, so what happened? We filled our gap, which is your main target. So if you hadn't exited here, you sure would have wanted to exit when you got this potential exhaustion reversal in the form of a 2 up, 2 down, because you know you're at possible upside exhaustion now because you filled your gap. So you cut your whole position here if you didn't take profits here. Okay, then what? On the very next candle, you get a 2 down, 2 down continuation that fails and goes 3. Is that actionable? It sure is. So you can get back in long at the 50% mark, right? Because that's a 1 bar rev strat. The day's still green. We're still very green on the day. So you can still look for actionable signals, and in a bullish 1 bar rev strat, you're entering at 50% of the previous candle with your stop at the low of the previous candle. Okay, you can take more profit right here, or you can just trail your stops up the lows of the 5-minute candles, because you know price can't reverse until it shows you it's going to reverse by breaking a previous candle's low. So what happened here? You hit 1, 2, 3, 4 out of 5 targets before getting a 2 up, 2 down reversal against you. This almost went outside day. That would have been that level up there. So again, here's an example of a gap down for buying, and always paying attention to possible exhaustion risk, like we found on the daily, knowing where exhaustion levels are, and playing in the direction of daily time frame continuity. So here's an example that didn't follow the rule of thumb that gap downs are typically for buying. This is when you are definitely going to use the daily time frame continuity. You're going to keep this in mind. So Lyft on the day had earnings, gapped way down. So we closed here at 1622, and we opened here at 1115. This was a 31% drop. So what do we want to do? First and always, we want to mark our daily open, and we want to search for potential exhaustion. Okay, and what else do we want to do? We want to get our targets. Anything below the open is going to be a target. And remember, if you're downside biased, you're targeting the lows of the candles. Okay, so what happened with Lyft? Why didn't the buyers step in and buy this dip? I don't know, and you don't know, and it doesn't matter. But if we had to guess, that 31% drop probably really scared any potential investors, and they probably didn't want to buy. But again, it doesn't matter. All that matters is time frame continuity and actionable signals in the direction of time frame continuity. Okay, here's Lyft on the 1 minute. This one was a little trickier, but opened here. The very first 1 minute stick was buying, and then on the second flip, we got a continuity change back below the daily open. So this would be a more advanced method, which is a continuity flip. So the day, when the first 1 minute candle closed here, the day would have been green, right? Because we were above the open. And then the second candle of the day flipped and instantly went red, trading back below the daily open. And this is what a lot of traders in the technical analysis world will call a green to red move. We just call it a continuity flip. If you're very aggressive, play the continuity flip, and then your stop would just have to go right up here at the high of the day, because you're expecting the day to turn red and not go back green. So you would not want it to go back above that high. Okay, and then this thing just tanked till it hit your second daily target. But this is a great example of daily time frame continuity in trading, how you know if the gap is going to get bought up or if it's going to get sold off. It all has to do with where we open. You got a 5% move in 5 minutes. So this is also why people love to play gappers, because they are so volatile and they move so fast on the open. Also another reason why it's more of an advanced strategy. You have to be fast. You have to know what you're doing. You have to be prepared to stop out if you're wrong and they want to change the daily color relative to the open. Okay, I think I'm gonna call it here. Hey guys, welcome to lesson 15 of the Stratucation course called Studying and Nightly Homework. So the strat is so repetitive and so fractal in its nature that practice makes perfect, just like with anything else. So when you're learning the strat, hindsight is an excellent tool to help you build foresight. So when you get into the market and you're trading in real time and using real money, this is going to help build your confidence. So what I would like for you guys to do every night is find a daily strat setup that hit its magnitude. So anything on this chart. So if you're looking for a bullish setup, you're going to be looking at the left side of the chart. So you want to draw your daily trigger and your daily target. Okay. So I found a nice example on AMD. This is a bullish 2 down, 2 up reversal. So this magnitude is your take action area. So what you're going to do is go down to a smaller time frame. Now, this one moves so fast that I had to go down to the smaller time frames, but you can pick any time frames that you want. You can use a 5-minute, a 15-minute, a 30-minute. And then what you're going to do is you're going to find all the bullish actionable signals in. You're going to mark your trigger and you're going to mark your stop. This is our magnitude. So we're actionable as long as we're in this gray box, okay? So I've got the 3-minute and the 5-minute. So we're just going to mark all of our actionable signals that we see, anything that's bullish. So have this sheet next to you when you're doing this. So you could take the daily trigger right off the bat. That's okay to do, but you're going to have a super tight stop because if it doesn't work, you want to get out of it right away. So there's one entry and a stop. Okay, then we have an inside, a 2-1-2 up. And if you're using a 3-minute candlestick chart, you might, because these candles are smaller, have your candles at the lows instead of the midway point. That's up to you. We have a bullish 1-bar rev strat. Enter when we got 50% of the way through the 1. And then our stop would be at the low of the 1. So there's another way in. 3-2 up. I don't trade continuations like that. So 2 down, 2 down, 2 down, 2 up. Same exact actionable signal that we're trading on the daily, right? And we've hit target 1, right? So you could take partial profits here and see if it keeps going and hits target 2. 2-1-2 up. Stop at the low of the candle. So far, this is the only entry that would have stopped you out. Okay, and that's going to happen sometimes. But if you're in from here, 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 and here, stopping out here is not a big deal. You already are in profit. So keep looking to get back in. You got another outside 3. We get another, 2-1-2 up. Stop's going to go there. Another 2-1-2 up. Stop is going to go there. Didn't quite hit magnitude yet, did we? So we have one last little way in. Boom. So we had 1, 2, 3, 4, 5, 6, 7, 8, 9 ways to get in and participate in this move with clear stops. And then boom, once you hit your daily pivot high target, that's of course where you want to fully exit. And if you just do this every night, practice, and then you can do it on the 5-minute chart. The 5-minute chart had a lot fewer entries, really only this 2, 1, 2 up. So 1, and then a 1 bar rev strat, an outside bar, 2, that was it. So when things are really moving, sometimes you have to go down to the smaller time frames to get in. And again, the more you do this, the stronger and more confident you're going to be in the strat and in your entries and your stops. Okay, here's an example of a bearish 2, 1, 2 on the daily, 2, 1, 2 down. So then you'll look for bearish actionable signals on a smaller time frame. So again, always mark your trigger, mark target 1, mark target 2, and then we know this is our what? Our take action window. So here's the 5-minute on Walmart. Again, if you want, you can always take the daily trigger, but your stop has to be a new high of day. Okay, so there's 1. Then we get a bearish 2, 1, 2 down, and that's target 1. So we did hit target 1, and then your stop, you can have at the high of the candle or the 50% mark. Okay, 2 down, 2 down, 2 down. That's continuation. That's not actionable signals. We get another 2, 1, 2 down. Two down, 2 down, 2 down, boom, final target hit. And then look at that rally away. So that's why we teach and train you guys to always exit at your main targets, because this happens after that, because that's smart bears closing their positions and covering, and they have to buy to close. So, and then you can do it again on the 3-minute. So again, you can take the daily trigger, stop goes at high of day, 2 down, 2 down, 2 up, 2, 1, 2 down. So entry there, stop there, continuation, again, 2, 1, 2 down. And then we get a bearish 2 up, 2 down. So that's another entry. Stop there, boom, target hit, exit. So this is exactly how I want you to be doing this. And again, your stops can also be at 50, depending on how tight you want your stops to be. Do this, I promise, you're going to learn so much faster. All right, I'll see you guys in the next one. Hey guys, welcome to Stratucation Lesson 16. This is going to be on setting up your trading platform. So I'm going to do a video on TradingView and a video on TrendSpider, just kind of walking through important little things that you should have, or little tips and tricks if you didn't know them. So the very first thing that I'm going to want you guys to do is go into your settings, go to symbol, and then make sure this isn't checked, because if it is, it's going to screw up your candle color and time frame continuity. Then there's just a lot of settings, if you start clicking through here, that you can select or deselect. So if I uncheck this, you'll notice that my timer goes away. So these are things that, you know, are up to you to have. So just kind of play around in there a little bit. Appearance, all again, completely cosmetic and up to you how you want your charts. But this is how I do the 2-tone color, is the background is set to gradient, and then you can pick your color combo. See how it'll change. If you want a watermark or not, again, all cosmetic stuff that you guys can play around with. I don't trade from TradingView, so none of this really matters to me. Events, if I wasn't on SPX, this would be things like when earnings are, they'll show up at the bottom of your screen, stuff like that. Y'all know I like a 3-screen layout. You click this button up here, and that's how you can select what kind of layout that you like. You can do a 4-screen, you can do whatever you want. I like the 3-screen vertical. And then these are the settings if I want the same ticker but different time frames. So these are all SPX, but it'll always be the month, the week, and the day, no matter what ticker I go to. So if we went to like VIX, it'll still be the month, the week, the day. If you want your time frames up here saved at the top for easy clicking, like if you wanted to go to the 4-hour, and then, oh no, we want to look at the 1-hour. How you do that is this little drop down menu, and then you just put a star next to your favorite time frames, and then that will favorite them up there. Same thing with your favorite tools. If you favorite them, you can add this, which is a favorite bar. Then I always have these 3 things highlighted or on. So new drawings are replicated to all charts, and the layout, basically it syncs my drawing tools. This keeps me in drawing mode. So what this does is it allows you to use a same drawing tool over and over without having to come back and re-click the line. And then if you are done with a certain drawing tool, like the line, you just right click, and then that stops the drawing. If you want to quickly delete what you just did, you can hold down Control and then keep pressing Z. It's kind of like an undo button. The only indicator that you're really ever going to need on TradingView is called this, the StratTeach V2. And it'll look like this on your chart. And then there is a jillion settings that you can come in and change and customize. So you can tell it if you want your number bars, so like 1, 2, or 3, if you want them above the candle or below the candle. You can pick their size. You'll see they'll get bigger. I just keep mine to, I think, large. You can select what color you want your 1s, 2s, and 3s to be. And just a whole bunch of settings. So if you like an EMA, you can put an EMA on your chart. If you like VWAP, you can put VWAP on your chart. Just a whole bunch of stuff. Show multiple time frame, basically highs and lows. If you want to see patterns on the chart, it'll show you what is what. Well, what else? It's got the 0.5 fib, which is this light gray dotted line. You can customize that however you like. I think the style and visibility tab, I don't think those do much. Yeah, I didn't mess with any of that. And I forgot to mention this, magnet mode. I always have my magnet mode on because I want my drawing tools to snap to candle highs and candle lows. So for instance, if I was to get a line, it snaps automatically to that candle's high. And if you turn it off, I'll show you, it doesn't snap at all. It just puts it exactly where you put it. And I want exact levels, and you'll see the snapping effect. There's also a different levels of your magnet. I just have mine on weak. Strong is pretty crazy. There is little menus to the right of these things, and there's tons of stuff in here. All these fib things, all these, you know, different, if you want a rectangle, if you want a circle for some reason. So don't be afraid to play around in here. You're not going to break anything. If you want to make templates for what your lines do, click Align, click Settings, and then you kind of just make your line however you want it to look. You can change the color. You can change if it's dashed. You can change the thickness by down here. There's so much that you can do. Text, if you want to say that this is a trigger, you can do that. People like how I have little emojis next to some of my lines. The way that you do that, on a Windows computer, I don't know about Apple or anything, but on a Windows computer, in this text box, you hold down the Windows button and hit the colon button, and that'll pull up emojis, a whole bunch of them, right? So that's where you can get your little emoji for your trigger. And then if you want to save this as a template, hit Save As, call it what you want it. So you would call it trigger, which I'm not going to do that because I already have one saved, and then you would hit OK. And what this does is when you have your line on your chart, whatever it is, you can right click it, hit template, and then pick your trigger. Or if it's a target, you can right click, hit template, and then call it a target. So that's why those are kind of fun. It just speeds things up. If you want to clone a line real fast, hover over the line that you want to clone, press and hold down the control button on your keyboard, click and drag. That's it. Let's say you want to add an alert on a line, right click, add alert, enter. Easy. You want to have sync and layout. And then all your drawing tools will go to all your charts because you don't want to lose your levels, right? Also, the Strat THB2 has average true range, which is nice. So for instance, the average true range, I guess no matter what time frame you're on, I don't use this indicator, but whatever time frame you're on, it's going to give you the daily average true range. So even though we were on the monthly, it's still giving us the daily ATR. I think everybody knows pretty much how to use a watch list, but if not, you can create a new list. You can call it swing. And then to add tickers, you just hit the plus sign. And see over here on the right side, it's adding them. That's how you do that. You can customize the columns. This is for any open alerts you might have. All kinds of fun information in here. I usually don't mess with any of this stuff. Oh, a nice little economic calendar. That's for basically the social media aspect of TradingView. There's TFO stuff. What else? Here's some other indicators that I have favorited that I like. And you can play with these, just search them. Like if you wanted to search any of these, you literally just search for it. and then find the author of the person that I'm using, which would be right here. You'll see the authors. Oh, this is important, and I find a lot of people don't know how to do this. To take a screenshot, you just click this little camera button. They make it so easy. You don't need to download them unless you want to save them on your own personal computer for some reason or like a trade review reason. You just hit copy image and then right click, paste, and it pastes the image right there on the screen. Here's where you select your candle type. We in the Strat and real price action traders use actual candles, no Heikin-Ashi candles, none of that average stuff. We want exact levels. If you want to pop out a time frame, you just click this center button. See on the bottom left side of the chart where the cursor is. Click that center button, and then the month pops out. To put it back the way it was, again, click that center button. If you've messed your chart all up for some reason and it's all out of whack, all you do is click this reset chart view, and then it goes back the way it's supposed to. I also keep my charts on auto. Some people do logarithmic or log scale. I don't really see much of a difference. I don't think that really matters that much. Oh, down here at the bottom, there's all kinds of stuff. There is some sort of stock screener in here, but I do not use it. If you want to paper trade, you hit trading panel, and then you just click paper trading by TradingView, and then click connect, and then it'll set up a little fake account for you, and then you can trade right on the chart. You can watch some YouTube tutorial videos for how to do that. It's pretty easy though. There is also something called chart replay. So if you want to go back in time and watch how this played out, you can do so. You can change your speed as well. This is actually good for strat practice. You can just call candles what they are. 2 up, 2 up, 3, 2 up, 2 up, inside, 2 up. It's kind of like a little flashcard game, right? If you have a ton of stuff on your charts and you just want to clear it off, you just right click, remove drawings. Say you've got like 10 indicators on one of these screens. So this one has 8, this one has 6, this one has 7. If you want them to all have the exact same indicators, you just right click and then hit this, apply these indicators to entire layout, and you'll see this 6 will change to an 8 and this 7 will change to an 8. We'll hit it. See? So it does it all for you. And I do prefer TradingView to draw on. I just find it much easier to draw on than TrendSpider. And then if you want to save what you've done, just click save. If you want to share a layout, you gotta turn on sharing and paste that copy to someone, and then they can click on it and get to it. So yeah, lots of fun things that you can do in TradingView. Hey, I think that's all that I can think of for now. All right, until next time, bye. Hey guys, in this Stratucation lesson, we are going to talk about TrendSpider and how I have my platform set up. Me personally, I use TradingView more for my charting and drawing on my charts. I just find it a lot easier and more user-friendly, but I do like TrendSpider for the scans that I actually made. So we'll kind of talk a little bit about this platform. So up here, top left, that's your ticker window. This is your layout. So I still like the 3 vertical layout, so I stick with that. So they have a strat indicator built in, so you don't need to go and find a script off of like TradingView or something. It's already built in right here. You can just click the 3-dot menu. You can type strat, and then you'll click on it, and then this will populate, and then you can tell it if you want to see the 1s, the 2s, and the 3s on your chart, and then you can also customize their color. So it's nice that it's built in and ready to go. They do have strat candlestick patterns built in as far as like recognizing them, but if you ask me, I don't care about them when they happen after the fact, unless you're trying to teach yourself how to identify what a 2-1-2 looks like. Otherwise, it's too hindsight and doesn't help you. Then I don't use anything chart patterns. That's a lot of technical analysis stuff, which we don't use, obviously. I don't use heat map. Not entirely sure what it is. Like I said, I pretty much use the bare bones of this platform. Other data, I just want to know when earnings are. So I have my earnings on, and then you'll see at the bottom of the screen, it shows up as a little E. So that's handy. This is your sidebar. So I've got my watch list set up here. There's a scanner, whatever scanner, all of these are my scans. So whatever I choose to look at will kind of populate in here. So if I'm looking at an inside bar scan, it'll show me all the tickers for an inside bar scan. And then this smart checklist little widget thing is your full time frame continuity. So again, you don't need to go and find a script for it. It's already built in. You just click on that and then scroll down to the F's for full time frame continuity. You can have a intraday one, which is the day and under, or a higher time frame one, which is the month and under, or you can use both. You just have to tell the checklist that you want to add a new column. And if you do choose TrendSpider, I will share my scans with you. Anything that says SSS is a my scan. Oh, well, these are all my scans too that say Strat 60, Strat day, Strat month, week. So those are all mine. So I will include that in this lesson. So let's look at this. So a Strat red 2 up on the day. And you can tell it what you want it to scan through. They have a whole bunch of different stuff. Too many things to scan through, in my opinion. As far as I know, you can only do one at a time. And I only look at my watch list. So I only scan my watch list, which you can see it says right there. And then you just hit scan. Okay, so this is a day red 2 up. So let's see. So Google on the day is a red 2 up. So if you only want to play red 2 up, 2 down reversals, this might be a scan that you like. Or if you only play green 2 downs, click on the scan, hit scan, and then it'll show you all the green 2 downs on the day. You can also clone the scanners, so it'll make a copy of it, and then you can edit it. So like say if you wanted to make all of these a weekly scan. You would just scroll down, put week, week, week. So you have to change all those 3 time frames if you want it to scan for weekly green 2 downs. And the only one that it found was HD. And then you could save that as a new scan. And then if you want to make a watch list, you just type your ticker and then separate with a comma, and then it'll add it to your list. Not too advanced when it comes to TrendSpider. They have strategy testers. I don't mess with any of this, so I'm not the best person to learn from, but they do offer like a one-on-one session if you want a tutorial or for them to help you kind of set your stuff up. They got news. This stuff is new to me. A seasonality widget. I wonder if you can add to the visible. There you go. And you can kind of scroll down and see it down there. Yeah, lots to play with. They've got YouTube videos too. But I just wanted to cover like the important strat stuff. Of course, here's your drawing tools over here. Play around with those. They'll say what they are if you hover your mouse over them. You can add after hours or pre-market. So yeah, that's about all I know for TrendSpider. Hope this was a little helpful.
Still fresh.
Still fresh. Hey guys, in this Stratucation lesson,